Welcome to our public meeting of the Retirement System Investment Commission of February 26, 2015. I hope everyone had an easy time getting in this morning without too much difficulty. I understand even the legislature decided not to come to work today. So maybe they need a holiday.
This is Reynolds.
Oh, all right. Did you have a problem, Reynolds?
Was a combination of weather conditions, spousal anxiety, and a cold.
Oh, that's what you call a triple whammy.
That's a perfect storm.
Yeah.
All right, well,
The
let's...
middle one of which is probably more important than any other.
Okay. All right, well, let's proceed. So we'll call to order and consent agenda. And the first item on the agenda is the adoption of the proposed agenda.
So moved.
Any second? Second. All in favor, signify by saying aye.
Aye.
Aye. Motion is carried.
Okay. Next would be.
Second item will be approval of the minutes.
You just ask if anybody has, for the October 2nd, anybody have any additions?
For the, we'll start with the, what is it? The October 2nd, for 2014 minutes. Are there any additions or deletions?
Oh, okay. We'll come back to that.
All right, hearing none, may I have a motion to approve?
So moved.
And second? Second, and seconded, so all in favor?
Aye.
Aye. Okay. Next one is the approval of the minutes of the Commission's October 23rd, 2014 meeting. Anybody have any additions or deletions to those? Hearing none, I have a motion to approve?
So moved.
Second?
Okay.
All in favor?
Aye.
Aye.
It's unanimous. And lastly, the commission minutes of the November 20th, 2014 meeting. Do we have any additions or deletions to those?
I do.
Yes,
First, I'd
Mr.
like to say
Chairman.
thanks for all the work. I know how much work it is, and you get all three of them done. Whoever had to do it, thank you. I like the minutes to more accurately reflect the actions of the commission in regards to the discussion of the vote concerning asset allocation and the 10 and 30-year assumptions. It may be most accurate if we could either include the transcript, or if we could include the transcript and the page 51 from the HEK presentation. And that's the one that had I have copies if you like it. Let's see. That's just the actual page that had, sorry, pass these out. I just got all this stuff this morning.
Those were publicly discussed. So
Yeah.
they would be in the, they'd be in the meeting materials, so. Yeah.
If we wish to include those, I see no problem with that.
Thank you. That'd be a big help.
All right. Any other?
One scrivener's error. Dory, do you want to?
On page 6 of the minutes, there's a portion where it says Chairman Gillespie recognized Mr. Gillespie, and it should be Chairman Giove. So we'll make that change if the minutes are approved.
Anything else? If not, have a motion to approve,
That's amended.
as amended, I should say.
Right.
Moved. Second?
Second.
We have a motion.
Second. All in favor?
All those in favor? signify by saying
Aye.
Aye. Motion- Motion is carried. All right, now, let's see.
your
Next one
chairman's
is the
report.
chairman's report, and
Let's read that.
first, Alan Gillespie requested that consideration be given to amending the commission's governance policy related to committees to require that each new chairperson select new members of committees or reaffirm the current composition of each committee. Secondly, although the governance policy currently allows a new chairman to present a different composition for committees to the commission for ratification as appropriate, the policy does not require affirmation or modification of the composition under a new chairperson. Thirdly, to address Mr. Gillespie's concern, the following language is being proposed for addition to the committee's policy as the last sentence in section B1. The commission chairman will present an initial slate of proposed committee appointments for ratification by the commission no later than the second regular commission meeting of the chairman's term. So, is there any discussion? Hearing none, I'd like to have a motion to to
Adopt the change to the governance policy.
adopt the governance policy 6BC1 to provide that
And
the statement that was read, again, the commission chairman will present an initial slate of proposed committee appointments for ratification by the commission no later than the second regular commission meeting of the chairman's term.
I'll make that motion.
All right, and a second?
Second.
Motion's been made and seconded. All those in favor signify by saying aye.
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 It's unanimous.
Unanimous? Okay, thank you.
Next item is the executive director's report.
Thank you, Mr. Chairman. I wanted to start out my executive director's report. As you can see on the screen, the staff and I probably back in, I think it was back in December, I challenged our staff to come up with a slogan that we really think, or that they would really think would define who we are from a staff perspective, what our culture is, to really give us something to fall back on, a lens by which to help us make decisions on a daily basis, to really help us focus our efforts on who we are and what we do. When I came in, I proposed that we adopt really a beneficiaries first attitude. And when I say beneficiaries, I of course mean everybody that we serve, the whole over 500,000 South Carolinians that we serve on a daily basis. But I thought that we really, to determine who we are as a culture from a staff perspective, we really needed to flesh that out and focus that. So we gave everybody an opportunity to make suggestions, and we took, in essence, nominations for that. And then we were very democratic in the process and actually voted. We narrowed it down to a slate of 3. I think just about everybody made a suggestion. Narrowed it down to a slate of 3, and what you see on the screen was by far the overwhelming winner of the vote. So I just wanted to let the commission know that this is who we think that we are as a culture from a staff perspective. Beneficiaries first, their future, our mission. It's something that we think about and consider every day when going about our duties and responsibilities. It's something that I'm very proud of because, I think as I've said before, culture is not something that you can really dictate from the top. It's something that has to grow amongst the organization. So the organization coming together and really laser focusing our mission into these words, I think is something that I'm very proud of. So I just wanted to make the commission aware of that. And the next item that I wanted to address was we here we go. On February the 1st, I just wanted to announce that on February 1st, MSCI Barra was chosen as our risk system vendor. The contract had a start date of February the 1st. MSCI Barra is a leading provider of risk systems for public pension funds, and of course will be a welcome business partner in assisting our portfolio strategy and risk management team in enhancing our risk monitoring and risk reporting capabilities. Our portfolio strategy and risk management team is hard at work with the Barra implementation. We hope to have that wrapped up in the next 6 months. I will certainly look forward to and will be sharing updates on their progress at kind of intermittently and at future commission meetings. But if you have any any specific questions, or please feel free to contact me, and we'll certainly keep you abreast of the progress. But it's something that we're very excited about bringing on and implementing. So next, the posted. I'm sure you saw it posted. The investment manager sourcing and conflict disclosure form. We recently made changes to the sourcing, conflict, and disclosure form that was originally approved by the commission back in September 2013. Of course, the purpose of this form is to disclose information about how new investment opportunities are sourced, and was implemented as a mechanism by which potential conflicts could be disclosed and reviewed. The changes that we made, we did couple of technical updates, some position and title changes, specifying that the form and specifying that the form relates to investment engagements. We also did some improvements from lesson learned utilizing this form for over a year. And we also added the requirement for the CIO to complete a sourcing conflict disclosure form for every investment, given his involvement in every investment. That change was not to steal Alan's thunder in his introduction, but that change was something that was recommended by our new Director of Enterprise Risk Management and Compliance, Eric Nelson, who Alan will introduce to you in a few minutes, and was, of course, supported by the CIO and myself. We also have instituted or have a exempt service provider sourcing and conflict disclosure form. In light of the FundSim recommendations, we created a new source and conflict disclosure form specifically for exempt service providers. For purposes of this form, exempt service providers include service providers or potential service providers that are exempt from the state procurement process and are selected by or approved by the Commission. For example, investment consultants. And due to the infrequent retention of this type of service provider, we don't anticipate that commissioners or staff will have to sign off or complete this form very often. But this new form does complete one of our FundSim recommendations, and we welcome it as a new layer of compliance oversight. Also wanted to give the Commission an update on where we are in the appropriations process. The House Ways and Means Committee, the budget process is running a little parallel in both the House and the Senate. The House, of course, because the bill originates in the House, is a little bit further along in the process than the Senate. The House completed their committee work at the House Ways and Means level last week. The House Ways and Means Committee, as you know, when I made my initial budget presentation, I believe back in October, I indicated that we would be asking for about $5 million in additional budget authorization and 9 new FTEs. The House Ways and Means Committee is recommending $3 million in additional authorization and 6 of the 9 new FTEs that we asked for. So I think that's a significant progress for us versus last year. I was also appeared before our Senate Budget Subcommittee last week, and so that process is being that's the initial part of the process in the Senate. So we'll be tracking the progress of in both bodies. I would assume that I think the House will be on the floor on the budget next week. Yeah, next week. So we should have a good idea by the end of next week where we'll be from the perspective of the House of Representatives, and then the bill will go over to the Senate. So just wanted to make sure that you were aware and updated on that. One of the other things that I need to do is, pursuant to the Freedom of Information Act, every year, even though we've decided on and published our meeting schedule, the Freedom of Information Act requires us to announce it again at our first regularly scheduled meeting of the new year. So just to reaffirm, we have meetings scheduled for today, obviously, Thursday, April the 23rd, 2015. We have a 2-day possible retreat meeting scheduled for June 18th and 19th, both Thursday and Friday. We have a meeting scheduled for Thursday, September 17th, 2015, and a meeting scheduled for Thursday, November the 19th, 2015. But again, that is just something that the Freedom of Information Act requires us to announce at the beginning of, or at the first regularly called meeting of the year. We do have a couple of new staff members that we would like to introduce. Mr. Gillespie, I'll turn it over to you.
Eric Nelson joins us from as a retiree of the Florida system, where he was, I guess your title was what down there again? I can't remember what it said on the resume.
Last title, Chief Risk and Compliance Officer.
Chief Risk and Compliance Officer, worked with Florida as they brought their ERM and created their ERM function. So he's been there as they brought it from the ground up. Now, as Eric will tell you, he had a few more resources to work with there than here. So he's going to do what he can with what he's got, and we're happy to have him. Welcome.
Mr. Harper.
Thank you. I'd like to actually introduce David Haas, who's joined us from UVMCO, where he was a senior associate for 4 years. Prior to that, he worked at Florida Capital for 11 years, so 15 years experience. David is joining us as the Director of Private Equity, and so we joined him right at the beginning of the month, and we've been running through the development, so there's a lot going on. So yesterday, he had a meeting with private equity, private markets folks at HUK, as well as Suzanne Bernard from HUK. So we're off and running and glad to have him here.
Thank you. And just one final item, just a reminder to all the members of the commission and the applicable staff that your statement of economic interest must be done by March 30th at noon due to the change that the General Assembly made. The prior deadline, as you know, was April 15th, which was easier to remember because it lined up with tax time. But in our governance policy, though, we still have that it must be filed by April the 15th. Obviously, state law overrides our governance policy, so I would just ask that and if we could just do this by way of a motion, that the commission approve a change to the governance policy for that particular item to reflect that it's actually due March 30th rather than April the 15th.
So moved.
Second.
All in favor?
Aye.
Aye.
Aye. Motion's carried.
All right, sounds good. And again, we're just replacing that's just making the deadline reflect
That is what we got.
March 30th. And we'll send out, we'll make sure that we send out a reminder email probably about a week to 10 days out, just as a prompt. So, and that completes my report, Mr. Chairman.
All right, does anyone have any questions for Mr. Hitchcock? If not,
I wanted to
sorry,
ask
Bob.
if we have had any staff departures.
Yes, sir. We've had one staff departure since the last commission meeting. Mr. Louis Darmstarter left the organization at the beginning of January.
Anything else? If not, then we'll move on to the CIO's report.
I think we're going to the audit committee first.
Oh,
Yeah,
I'm
yeah,
sorry.
there was a change. Yeah,
Was
we're
it-
going to the audit committee. Yeah, and I think that reflects that.
Yeah, I wasn't sure what the weather was, so I'd asked them to move audit committee.
Oh, okay.
Yeah,
All right.
it's reflected in the final agenda. This will get picked up in our.
Where is it?
All right, so, audit committee, audit committee's met, I'm trying to remember the last time full commission met, November?
November 20th.
November. So audit committee actually was busy in the interim. Conducted a series of interviews, which brought Eric Nelson to the organization. So we were busy on the personnel front. Kind of in conjunction with that, you'll notice we passed out an audit committee charter review. Most of the items on that, you can read that at your leisure. We review to make sure we're covering the items in the audit committee charter, but most of them relate to the ERM function, and given the nature of the personnel, I wouldn't say they necessarily, they weren't missed, but they weren't completed either. So, but we feel like we're making progress there. At our last meeting, we did get a update. Mr. Nelson just started with us this month, so he'd been on the job all of about, 5 days, before the last meeting, so he and Andrew presented a plan for their, a transition plan, calendar and timelines for the committee, how they intend to do it. One item we did discuss, and we had the gentleman from Clifton, is it Clifton, Larson, Allen? We did discuss the management rep letter, which RSIC provides to PIBA, in quite a bit of length, both on the desire for it, because we didn't automatically send it, because in the past we'd gotten requests from PIBA, prior to sending it, and PIBA hadn't sent across that request, and so we had not provided the letter. PIBA does feel it's a good practice, and we're supportive of that. We just wanted to make sure that not only are we doing the things we say we do, but if procedures have outlived their life, right, you obviously want to clear those as well. So we did speak with them, and address that issue, and that letter was sent as once the request came in. Around that. So I just think there's better understanding from both sides there. We received a report from PIBA's external auditor as well on the financial statements in interaction with staff. We reviewed obviously the audit committee charter, which I've handed out. So the 6 areas of noncompliance, 5 were related to the recently approved ERM and personnel changes we had going on there. And then we received an internal audit report on investment fees and expenses for 13 and 14. So that's what the audit committee's done. Yeah.
Can I ask a question?
Yep.
Did the audit committee, Peggy and I have been having this discussion, did y'all receive anything from the auditor about the changes in the CAFR and the financials from one year to the next?
No, the external auditor?
Yeah.
No.
Sorry.
And as we've indicated to you before, Mr. Treasurer, we're happy to sit down and review the CAFR with you. The CAFR is a statement in time. It's the financial position as of June 30th. So there really is no red line version of what's in last year's CAFR versus this year's CAFR, and the notes are reflective of the information that's in the CAFR this year. We and our staff are available at any point in time to meet with you or your staff to review
I thank you for
and
that.
answer any questions that you have about
The
that.
problem with that is, we have Bond Disclosure Council, Issuers Council, the Underwriters Council, we have the underwriters themselves, the banks, possibly Senate Finance and Senate, House Finance, the Treasurer's Office, the Disclosure Council. All these people will have to be briefed, and I'm just not capable of taking 303 pages of changes and spitting it back out to all these people with phone calls and things. So it's a real problem. Doesn't seem to me that seems to me we should be able to get some kind of written confirmations on major changes or meaningful changes, and that I can is a real problem. So, okay, that's all right. I didn't know if y'all had asked for something.
No, I wasn't aware, because, I mean, generally this agency is, passing information over to PIBA,
That's
right? And so, and this gets to that the management rep letter, but, we provide and respond, but ultimately we're not the ones compiling that document. So I think for this agency to, those disclosures, I haven't spent time on it, but that's not our document at the end of the day. We're providing informational content to it, and in the audit committee here, I think I shouldn't speak for the committee, but as chair of the committee, I'll speak for myself. Happy to comply and to help explain as much as possible. But at the end of the day, that's not our document,
That's
so
right.
we can't speak to the content.
You're a fund user, I'm an end user, and in all this thinking about it, the treasurer's office ought to have a rep letter that it sends. It doesn't, and we need to make sure that we're working on that in our offices. And I think the audit committee should seriously consider strengthening the letter we have, because it's really, while the end user PIBA is helped by it, it protects us. It protects y'all. If we know what we have to certify, and the head folks say, "I got to sign off on this," you tend to get a better product, or a product that's more pointed. And the treasurer's office has never been asked, and we haven't been provided one, but I'm going to require that of my folks, because I expect more out of them as well. So, and if y'all will help us with what you'd like to have, just let us know.
Yeah, and I think that would be helpful. And when the audit committee met, we left that discussion with both PIBA staff and the investment commission staff would work together to determine what needed to go into that rep letter to make it specific to our operations. And we'll be happy to work with the treasurer's office to determine what will be specific coming out of your operations.
Nothing further than we'll move to the CIA report. Mr. Harper.
Thank you, Mr. Chairman. And this morning, we've already started off with some of the updates with respect to the staffing and recruiting efforts. So I'd like to continue down that with my opening comments. And we've introduced Mr. Haas, and then we had a question as well with respect to turnover. And so we had already mentioned that Mr. Darmstarter is not with the organization at this point in time. Has left the organization. A couple of other updates I would like to offer would be private markets investment officer. We have an offer and acceptance out for Julia Lee. She's actually in Chicago. 15 years experience, graduate of Northwestern University. For those of University of Chicago grads, that may not be welcome news.
Great school.
CFA. She's worked as an analyst and a portfolio manager, most recent position at Allstate Insurance for a little more than 7 years. And then she has another 8+ as analyst at XL Capital as well as Transamerica. So she'll be joining in a couple of weeks. I think it's, the actual start date is March 16th. So looking forward to having her on staff as well. Other open positions would be an investment officer for real estate. So we have 2 interviews scheduled in the next coming weeks. 2 very experienced gentlemen there. And then also we have the senior investment officer for private markets that we're posting for and recruiting for right now. With that said, we continue to take a look at the needs of the organization with respect to the talent that we recruit and seek in the market. We also are well aware that there are folks very near to us as well. And so what we've instituted, working with John Farmer, the Director of Human Resources, is developing a training program. And we've thought about this from, some of you may be familiar with the bank models or investment bank models, where you have a person come in and they'll work in different business units to get a full breadth of experience. And so while there's no guarantee that we can offer from an employment perspective, it is a program that we would like to be able to let new employees come in from a trainee perspective to be able to experience everything from operations or legal or investments. And so they get a full flavor for the organization. They'll know the organization better, and I think it'll make them a much better employee as well. So that's being instituted. Look for, I believe, a full rollout. John, correct me if I'm wrong? By June? So we've identified 2 initial candidates for that program. One will be starting next week, and while the training program won't start till June, we'll actually have him help develop some of that, so he'll know exactly what he's getting into. His name is Kevin Matherly. He's currently, or was working at Credit Suisse as a financial analyst on the prime services and middle office. So we look forward to having him join, and then we also have an intern, Corby Selvey, who will be joining on the full-time training program in June as well. So looking forward to having that program established and rolled out. So I'll pause there to see if there are any questions, and if not, we'll get into topic 2.
Yeah, I mean, this is just kind of a budget-related question. I mean, I know last year there was some talk that we were going to hire, and I guess this is kind of a question for the HR committee, hire a compensation consultant. I know we're making a lot of hires. We have 6 new FTEs, right? I mean, where do we stand on that? Because obviously you're bringing people in at, you know, decent salary levels, and it's hard to roll back, right? You know, offers if they come out. I mean, where does that stand? Is that still something we intend to do?
The training program that Ursula's referring to, I mean, those will be very junior level, and the salaries will be commensurate with that. The other FTEs, that we feel like Phil, Mr. Haas, Ms. Lee, those are all FTEs that we had already in this year's budget. So those are ones that we're filling that we were authorized last year. The 6 new FTEs probably going to be split about evenly. We don't know. Ultimately, it's still early in the process. We don't know what we'll end up with. But if, let's say, we ended up with 6, we'll probably have a pretty much equally divided between operations and investment. But the compensation consultant, John, I know you guys met with them last week.
A couple days ago, we met with procurement. We received 4 submissions, and we're in the review stage now. And I believe our meeting is March the 5th or 6th for our next sit down with procurement. We had 4 respondents. We had, although gone nationally, we had 7 target organizations, all the named consulting firms that you want to have in there, and 4 chose to respond. So we've got some good organizations with proposals in hand, and we have a 3-member panel that's doing the review right now. And like I said, we'll sit down and enable the selection process to begin when we have that meeting the 5th and 6th.
Yeah, and we hope to have that deliverable in time, so that when we go to, and obviously we're not going to, if we get 6 new FTEs, we're not going to bring them on July 1st, but we can at least begin recruitment, and we'll have that deliverable from the compensation study ahead of time, so that we know where we would be, plugging those in from a salary perspective. And
if I could add, Mike, I believe our target is the May commission meeting that they would present.
Okay.
No further questions on the human resources front, then we'll move to topic 2 under CIO comments for strategic partnerships. And I'll just take a few seconds to give a little history to make sure we're all familiar on the same page. One, we do have W.L. Ross coming in a little bit later today to give an update on that partnership. But strategic partnerships overall is an implementation vehicle the commission created starting around 2008. And The idea behind the partnerships were that these could be larger pools of very flexible capital to take advantage of various market dislocations and very specific idiosyncratic opportunities in the market. They've been very successful overall. With that said, over the past 2 years, we've continued to add more staff to those partnerships, and when NEPC was still the consultant, their last assignment was to do the deep dive and have that report delivered back to the commission. Since that point in time, there has been that handoff to HEK as well to continue working with staff on the partnerships. Excuse me. And the model that we are currently implementing is we have a strategic partnership coordinator assigned to each partnership, and then multiple investment staff working with that person for the underlying investments as well. So there's more than 1 or 2 people assigned to each partnership, and so there's a lot of coverage. Also, as part of the ongoing transparency and reporting, is part of the administrator's role to actually do the deeper dive and start reporting more from within the partnerships themselves. And while the reporting is nice, you get to see what you hold. We think that it's very important too that the commissioners, while the staff has a lot of interaction and frequent interaction with the partners, it's also very important, we think, because these are larger pools of assets for the commissioners. They have that opportunity to see them and talk with them in person. So we had started that initiative several meeting cycles ago, where we've brought in the strategic partners. So you've heard from Goldman Sachs and GSO and Apollo and Grosvenor, and again, this meeting, W.L. Ross. And so we have others such as Entrust and Lighthouse to bring back in as well. So we'll continue that cycle to make sure the commissioners have the opportunity to visit directly with those partners and have a thorough portfolio review and ask any and all questions that you would like. So I'd encourage you to ask questions that you may have for the W.L. Ross team a little bit later today. So I'll pause there before I give a quick update on performance.
How many strategic,
Sorry.
quickly, how many strategic partnerships do we have?
So we started with 14 and we're down to 7 active. And so there are, the 8th one is in a liquidation phase.
Who's that?
Morgan Stanley.
Sorry.
So
Thanks.
now I want to be careful with that, because the partnership with Morgan Stanley is in that liquidation phase because of the underlying assets and the liquidity there. We still consider them, a great firm, and we'll continue to look at investments with them, which will actually have proposed investment a little bit later today for Morgan Stanley.
And I was just going to, I think it's really a great idea to have the strategic partners come in and meet with the commission periodically, but it would help educate me if I could understand what the routine reporting, how and when the commission gets reporting on the decisions that are made in the strategic partnerships and the co-investments, things that don't come to the commission. I'm not quite sure I understand which decisions are outside of the commission's authority and when and how we get reported on that information.
Sure. So walk back through the investment process. So a normal investment that's outside of the partnership. Okay. So the staff, along with HEK, will conduct due diligence, and the staff has an internal investment committee. So that investment gets presented at that committee, and if it gets approved there, then it comes to the commission for final approval. And if it gets approved, it goes through the contracting phase. So the difference in a partnership is the commission has granted the authority to the CIO, delegated that responsibility to the CIO, to make that decision at the strategic partnership level, since those are their own self-contained vehicles, if you will. All the investments go back through the same underwriting process. There's a prudence memo that HEK provides as well. They get presented at the internal investment committee, and then if they get approved, they go to the strategic partnership investment committee for final approval.
And so when do you come back to the commission and report to us on the decisions that you've made through that delegated authority?
Sure. So that would be through, there has not been a routine reporting mechanism to say, here are all the decisions or investments that have been made. And so that's one of the things we're actually working on with the administrator, to make sure that all those are, internally we have the files and so on and so forth. What we're trying to do is actually work with the administrator then, so that transparency and that detail then gets reflected in the formal books and records, if you will, so you can actually look at a partnership and all the underlying holdings to it. So that's what we're working on with the administrator right now.
And I'm assuming that, as you catalog all of those decisions that are made that don't quite come up to the commission level, that Eric, through the risk management, will be evaluating that to determine any risk associated with that and that will flow through Monica to make sure it gets incorporated into our audit plan. I guess I'm just trying to make sure that we have the appropriate risk analytics and auditing of those functions.
Yeah,
that we don't see.
and I can give you a little character. When we undertook this project starting a couple of years ago, we outlined what are some of the key documents that we as a committee and audit committee expected these partnerships to maintain. Minutes of these meetings, the PPMs. Now, we haven't, to Herschel's point, there's a lot of that hasn't flown up, but the audit committee did do a pretty extensive, Monica, you can kind of talk about it, what all we had on there, ADVs, tax returns. Minutes.
It was a full look at each strategic partnership, and we looked at it to make sure that what the committee had anticipated and expected actually got done, that we had all of the documents in place that were required to be in place. From that, there is currently on the audit program a strategic partnership compliance review. That's the one that I think Andrew had begun working on, but because they had started their process of looking at the strategic partnerships and narrow them down, that kind of went on a hiatus or a hold, and so that needs to go back where we're actually looking at some of the governance concerns that you're talking about. But that was
and I can speak to something really quickly that Herschel probably adds to it, because I've done a lot of completeness checks. The completeness checks for the strategic partnerships investments, they fill out the due diligence report, they still go to compliance for the completeness check, they're still discussed at IAC. So the one step that you aren't seeing is it's not going to the commission, it's going to IAC, but we still have the same due diligence report, the same completeness check, the same completeness certification that we would have with an investment that went to the commission. That's the way the due diligence guidelines are written. Sure. So.
And is that true for the co-investments as well?
Everything in there. Yeah.
There was, in there, not a wrinkle, but once the strategic partnership enters an asset class, it doesn't have to come back to the committee for further investment in that asset class?
To the commission. To the commission.
The commission. No, or even the committee. I mean, it's
Yeah,
my remembrance.
if they did a fund investment, that would be true.
Right.
Right.
So if we elected to invest in Energy Opportunity Fund, then we've underwritten the fund investment.
Yeah.
And then the GP, the general partner, has the responsibility for investing in the underlying companies or portfolio holdings.
It's been a while since I've read those contracts, but I thought that it talked about asset class, not a particular fund. And it may be something we just never took advantage of. But good, it's good progress, great progress from 3 years ago. I mean, that's heroic. If I thank y'all, Andrew, thank you.
Yeah, but to Herschel's point, the reporting mechanism, right? And I'm glad to hear they're trying to make progress on it. But the underlying governance stuff, I mean, the audit committee did a pretty deep dive and is pretty comfortable that it's there. Obviously, I would like to see the reporting improved, but the stuff we need is there.
And let me clarify too. When I say reporting, I'm talking about moving things from the administrator into Bank of New York,
right?
Which then will be fully reflected on what people would pick up and report internally. All these are actually broken out into the asset classes, so we actually break out every underlying holding, fund or co-investment, back into its asset class, and so we're picking that up from our risk exposures internally. So.
Thank you.
Good work.
Any other questions for Mr. Harper? Are you completing yours?
I have one performance estimate, then I'll turn it over to Mr. Berg and Mr. Bernard to do a deeper dive on the performance. So I don't want to steal the thunder from Jeff, but my numbers are going to be better than his.
Always.
But we're still
Put that out first.
still below 7.5. So he will actually give the update through 12/31, and these will be the official marked numbers and input from Bank of New York. So I'm using actually estimated figures where we do the proxies for the indices and add that on to the final numbers that we do have. And so the estimated fiscal year performance through February 20th, 2015 for the plan is positive 1.3%. The benchmark is positive 1.4%. So slightly behind the benchmark, but the good news is that we are now in positive territory. With that said, and hopefully I'm not taking too much of Jeff's comments here, is that this continues to be a challenging investment environment. If you look across the globe, you continue to see near or record lows of rates. The German bonds, sub 1. Japanese bonds, sub 1. They've been there for quite a while. You've actually seen the U.S. Treasury trade from a little over 2 to about 160, and now it's a little bit back over 2. And so if you think about that from trying to earn 7.5, it's certainly a very difficult environment. It was, I don't want to say easy, but maybe not as challenging when you have your short rates at 4 or 5% because you're halfway there from that aspect. With that said, we have a landscape of where you continue to take a look at global growth is deteriorating. You don't hear people necessarily talking a lot about inflation. They're talking more about deflation. So how do you actually stimulate economies and get growth going and get some modest price appreciation? And so that said, there continues to be risk out in the system. So it's really more of setting the tone or the temperament of, there could be a persistent lower rate environment to continue here. There are some additional risk on the horizon. In my mind, the Fed has taken their first step to tighten, if you will, by the fact that they've stopped quantitative easing. They haven't actually increased rates yet. It looks like that decision could possibly be delayed instead of mid-year to later in the year. So I think the big risk will be, will the markets react very differently than the expectations there? Obviously, there's a lot of geopolitical risk. We hear in the news of between Russia and Ukraine, things in the Middle East that are happening as well with ISIS. Obviously, Mother Nature itself, we can't discount the snow and the impact that could potentially have on economic growth within the U.S. Not long ago, we were talking about health scares with Ebola and the potential impacts that could have had if that would have spread broader than where it was as well. With that said, we continue to have, as you all know, a diversified portfolio when we think about the aspects of growth, income, and stability. And so we're diversified not only across asset classes, but across the various investment strategies themselves. And we maintain a sufficient level of liquidity to continue to pay benefits. So I'll stop there and turn it over to Jeff.
All right, thank you.
What was the date of your numbers? The date that you
February 20th.
February 20th.
All right, thank you. Before we look at the traditional performance data that we are accustomed to looking at, I'm going to focus some comments on how we think about markets and the economic framework. So internally, when we're thinking about the fundamental drivers that explain the performance of assets and the difference in performance among asset classes, we're talking about economic growth rates and inflation rates. And let me explain a little bit more what I mean by that. So asset prices reflect the market's estimate of the present value of future cash flows related to that asset. And that's not surprising to anyone. Over time, the changes in those asset prices tend to be largely explained by two main forces: the change to the outlook for economic growth and the change to the outlook for inflation. It's important for all of us to understand how different investments tend to respond differently to these types of environmental changes. And please notice that I'm not talking about the actual level of growth and inflation, but rather changes to forecasts for those factors. And for the purpose of the discussion today, I'm going to refer back to this framework because, at least for my comments are going to relate to the second half of 2014, the first half of our fiscal year. And the reason I'm going to use this framework is because for the last 6 months of 2014, it's actually a very interesting time period during which to observe the linkage between changes to these factors and asset returns. So the first thing I'm going to do...
Can I ask a question of
Yes.
first on the investment staff on
Yes.
that, just in light of what you say, because I think it's important, but I think it also, at this point in time, behooves a serious conversation, right? That, you talk about future cash flows, and in a negative rate environment, foreign bonds, which is 35% of the universe, right? That's a negative, right? Why should we be in this asset class, right? And traditionally, you'll run an asset allocation model, right? But essentially, it's a currency speculation. It's not an investment, right? which, as a investment plan, I think it really behooves the question of, okay, how, if, should we participate in an asset class where the future expected cash flows based on current pricing is a negative, right, for a substantial part of the universe, right? I mean, I think that's a big question, big allocations, related to foreign bonds, even some short-term instruments here being below the inflation rate, even though the inflation rate's come down, right? And then the second one, I mean, y'all know it's kind of my bugaboo, but, the commodities asset class, right? Certainly you can derive returns, but trend-following CTAs had a fantastic fourth quarter, right? Long-only commodities don't have associated future cash flow unless you're playing curves and things, right? So there's ways to extract returns in an uncorrelated fashion. I've never liked the way we've gone about implementing in that class. But, it doesn't meet that cash flow definition, certainly, right?
Well, in that case, the cash flow is the ultimate sale of the commodity, right?
Right.
Or delivery or what
Right.
have you.
Yeah, but most commodities, not all, right, but most commodities don't get better with time, right? That's a distinct difference, right? You keep a bunch of soybeans, you got to pay insurance, you got to pay storage, and they'll probably rot and get spoilage, right? So it's not a great store of value in that regard, right? You have to get a new crop all the time, right? So I mean, it's a different animal, right?
And to your point, go ahead, Herschel.
Yeah, I was going to say, so there are a couple of things, too, that are bleeding over a little bit into the AIP discussion that we'll have, too. But specifically with commodities, we've moved away from the traditional implementation of just the long swap piece of it, and we've actually worked very hard. The team has Justin Young and David Phillips and Wei Yi and Matt Dorchuk and others to take a look at, is there a better implementation? Because depending on where you're at, the roll yield can be very negative, and to your point, you have more of a declining value there because of the carry and storage cost, et cetera. And so what we've actually done is implemented swaps with several brokers and banks where they actually are playing the curve, and we're picking that up in the swap. And so from an enhanced perspective, you're getting that enhanced yield piece of it. But again, overall asset class, it hasn't necessarily removed out the pure beta component of it. So while it will outperform, or so far it has outperformed, the long-only index, you still have that degradation of return overall. And so part of what we're looking at there as well, because we haven't necessarily picked up the CTAs within commodities, we've thought about that from more of a low beta perspective, hedge fund perspective. And so there are a couple of hedge funds that do play the commodities curve that we actually have exposure to today. But that commodities perspective, we've actually don't consider that the hedge fund piece of it. We think of that from more of a pure inflation component of it, if you will. And so the next phase there is to say, okay, is there a better way instead of just buying the pure index, if you will, based on how they structure it, to take a look at the growth and the inflation pieces of which commodities actually drive or do better in those different environments. And then thinking about taking the active tilts towards, if we do believe inflation is going to, or deflation is going to reverse, and we're going to see inflation, allocate more towards those that are much more inflation sensitive. And if you see the growth aspect, then tilt towards those that are more growthy as well. With all that said, depending on the pure basic supply-demand dynamics, you may never get that perfectly right. You can't predict OPEC. They'll stop producing as much or continue to produce more. Those kind of things. So those are the thoughts we've had in commodities. I would agree with it, just the whole direct exposure it's tough unless you get back in that environment where you see commodities going back the other way.
And what y'all's thinking, I haven't looked at what y'all are proposing in the AIP, but I mean, the discussion on this foreign bond question.
Yeah, so that right there, and Jeff will actually have a proposal in executive session on some changes there. And so the idea is to give some flexibility to some other managers to allow that to be a tactical allocation when things change, but not to force that allocation there. And I would say from a bond exposure, we're going to continue to favor U.S. Treasuries from a government bond perspective. And while you don't necessarily have the same diversification benefit as if the 10-year had a 5 or 6 yield on it, there is some protection of value, if you will, if rates continue to go back the other way when we saw it go from a little over 2 to 160. So you do get some protection, but not the same amount of benefit. Also, I know there are a lot of people who continue to talk about even longer duration bonds. If we take a look at the past year, long duration bonds were up 20+%. So that would have been a great allocation. However,
when you start seeing the growth and the stability within the U.S. economy and the expectation of rates going up, well, that positive 25 could be just the reverse of the long bond. So, you know, for our position, we would still favor government bonds, U.S. Treasuries, but sticking closer to the 10-year, if you will. And we actually do have, and I'll say 10 years an in to a certain degree, and on the internal fixed income portfolio, we have more than 5 to 7 is where we position that. So, then we've separated out too, sorry, the last piece of that is we have, for some specific trades we've implemented where we've actually bought into the European markets, but we did not add the currency piece, so we've kept off the currency so we can have the market appreciation from the European markets, but not have the euro exposure as well.
Just to be clear, Alan, you were talking about foreign bonds, and you're concerned with the currency exposure?
Yeah, so 35% of European bonds right now trade with negative interest rates if held to maturity, right? So essentially, they're not, I mean, you mile out cash flows for 35% of that investment universe now, which would come through traditional asset allocation procedures as a diversifying asset, right? On an investment basis, it's negative, right? The only way to earn a positive return would be for the euro to appreciate over time relative to the dollar, right? You know,
So it's more the currency.
so now I've just basically made, you know, for a large part of that universe, it's, yeah, I'm now into a speculative environment because there's no associated positive carry on the yield, right? There's no positive future cash flow there, right? And so I think when you move from an environment where you're looking at positive cash flows to currency movements, right? I mean, not that there aren't returns there, but I'm now in a speculative realm, not an investment realm, right? And so my question, and this is about, you know, candidly bringing the money home, or, you know, things probably will revert, right? Some years hence, the euro probably will be higher at some point in time, but we got to know that's the bet we're making, right? So we're potentially introducing, I'll be curious to hear more during the executive session, but I just think that's a pretty material class, or for a pension plan to make that decision, we have to realize we're moving from an investment decision to a speculative decision when it comes to, you know, a large part of the developed world foreign bonds, right? Because they trade with negative yields. We're in currency speculation land.
Can I take what you said and frame exactly what you said a little bit differently?
Yeah.
If you're going to invest in something like the German 10-year where you're getting 35 basis points or wherever it trades today, which is not what we don't want to mix a whole lot of that in our plan because it makes it harder and harder to earn 7.5, right? But what makes that earn more than 35 basis points is an environment characterized by declining growth expectations and a severe decline in inflation expectations, which coincidentally, I'm going to show you in a couple slides, is exactly what's happened, right? So the bottom has fallen out for inflation expectations in certain parts of the world. And that has what has been propelling those yields lower vis-a-vis, you know, terrible news. It's not a great environment. So as the bottom falls out of inflation expectations, think about it, you're discounting all those cash flows by a lower and lower rate, which raises their present value. So it's a different way of saying the same thing, but absolutely right. And what happens in that environment, you need to have balance in your portfolio. You need to have other things that respond better in other environments. So that's really how we frame our thoughts, is how do we think about different asset classes and what are the linkages between changes to the economic environment and the outcomes for those asset classes. So let me, that's a heck of a preamble. So let me start here with a chart that shows us, this is the global GDP growth forecast taken from Bloomberg. It's consensus estimate driven, so it's not Bloomberg's estimate. It's a tremendous number of estimates compiled here. So what do we see here? It's hard to see on what the axis is because I just took this straight from Bloomberg. But what we see here is the outlook for 2015 GDP growth falling from about 3.1% at the beginning of our fiscal year down to 2.75% today. So this is not from an order of magnitude, the greatest drop that we've ever seen, but it's meaningful, and it's something that allows us to see assets react to it. The next chart is similar, only this is for global inflation for 2015. So this is a much more significant drop from 2.8% up here down to 1.9% today. And where we were on the way down at the end of the calendar year 2014, but I wanted to show you the continuation of that trend. So how do we connect the dots between these forces and returns for different asset classes? In some situations, there's a very intuitive relationship. So you see an environment characterized by rising growth expectations. That's quite a strong environment for global equities, as well as commodities. On the other hand, falling growth, that's an environment that's better for nominal bonds. Rising inflation expectations, quite good for inflation-linked bonds and commodities. But falling inflation is better for equities and nominal bonds. So before I move into the details of our performance, does anyone have any further questions on this framework?
Just going back to some of the earlier discussion about the risks in foreign bonds, isn't it true that some of the positives that you mentioned in terms of what's happening, for instance, in the European sphere, that because of the purchases by the ECB and falling inflation rates, interest rates have dropped dramatically, and then they talk about it because of the large purchases by the ECB of European government bonds, that there may even be a shortage of European government bonds, thereby increasing your returns, even though the rates are down. So it's there's more to it than just looking at the rate. And the second part of it is in the rates that are available, say, in emerging markets are substantially higher than elsewhere. Again, but there is a currency risk. So I guess trying to put all that together is not the easiest thing in the world, but I think you and I would both agree that I'm always a little skeptical of currency risk, having been burned more than once myself.
It's not an investment, right? It's
No,
speculation.
it is not an investment.
Can we table the currency discussion? Because
sure.
I'm going to get to
Yeah.
that in a few minutes. So this page, what this shows us is the performance not of our portfolio holdings, but of our asset classes underlying benchmarks. I'm going to focus in the middle column on the fiscal year-to-date period. Let me point out a few things that are noteworthy, and some of which I think won't be at all surprising. So I would argue the biggest news story for the second half of 2014 relates to commodities. As you can see down at the bottom, commodities are our worst performing benchmark, down 22% over the course of 6 months. It was broad-based, quite clearly led by energy. The energy sub-index was down 44% during this time. But it wasn't just energy. Everything struggled. Precious metals were down 15%, soft goods were down 20%. But against that backdrop of declining growth forecasts and declining inflation forecasts, the fact that it's negative is not at all surprising. Next thing I want to point to, and Commissioner Gillespie beat me to the punch here, is the high-grade fixed income. During an environment such as the back half of 2014, that's quite a good environment for nominal bonds. And you can see that even though we entered the fiscal year, and I think we actually had this conversation in a commission meeting, there's not a tremendous amount to get excited about. There wasn't in June. You're looking at the prospects of earning slightly over 2% for U.S. core bonds, and in the neighborhood of 1.5% at that time for non-U.S. investment-grade fixed income. As inflation expectations fall, though, that's a great environment for nominal bonds. So you can see here, we have, of all the asset classes, they're up toward the top. From there, I'd like to point out the relative to those higher quality sectors, the spread sectors, the credit sectors of fixed income performed poorly in relation to that, which again is consistent with that environmental change whereby the growth expectations are falling. Final thing I think I need to talk about is the currency environment. For a dollar investor like us, whether you hold a geographically diversified stock or bond portfolio, when you look across the developed markets and you think, okay, I can invest with or without the currency exposure, the difference in your outcome in the 6 months ending December 2014 was on the order of magnitude of 10 to 12%. That is an extremely negative thing for those of us that hold non-U.S. exposure. What does that mean for the plan level returns? If you think about equities as being roughly 1/3 of our plan, slightly less than that, but let's keep the math simple, and you use a negative 12% return for foreign currency. You take that 12%, 1/3 of that brings you to 4. Half of our equity exposure. We have more non-U.S. than most of our peers in public pension land. So we're more exposed to that by virtue of our more global benchmark for equities. So you take the 12% decline, 1/3 of our plan takes that to 4, half being non-U.S. That's a 2% impact at the plan level. So the currency is not insignificant. And as we sit here at the point in time at the end of December 2014, it's a negative influence. So I think it's important just that we understand part of what's happening under the hood here.
Jeff, just a question.
Yes, sir.
Of those numbers that you just gave us, and that 12%, would that be net of any hedges, or do we?
That's simply comparing unhedged foreign currency risk.
Unhedged.
To completely hedged foreign currency risk.
Would those numbers improve at all if we included any hedging?
It's always easy to look in the rearview mirror at this, and for that 6-month period, yes, it would have helped. When you think, I'm going to talk more about my opinion here, and I don't want to represent that as anything else. Developed market foreign currency risk is largely uncompensated. There's no expected return to it, right? Because you don't sit here and say, 20 years from now, the euro is going to be at twice the exchange rate that it is today, or half the exchange rate it is today. Right? It's kind of a zero-sum game, but it brings you volatility. So in my mind, that's something that we talk about this, and we're trying to figure out the best way to attack this. But it's risk, but it's not risk that brings you a specific bias from which you expect to earn an excess return. Does that address?
Let me add a comment too. As we think about moving through these cycles, and it was only a few years ago, the conversation was, why would you own dollars? It's losing its status as a reserve currency.
That's exactly right.
Yeah.
The past couple of years, it's why haven't you been owning dollars? Because you've seen the euro go from 139 to 113. You've seen the yen go from 80 to 120. And so I can promise you, maybe in 2 or 3 years, we're going to be having a slightly different conversation again. Trying to manage the currency impact over the long-term nature, one tends to think about it as a zero-sum game. It will all wash out. And so over that cycle, had you been long the dollar, you were getting squeezed early on. Now you will be back to even, so it will wash for you.
Well,
Can I add one thing?
Yeah.
I mean, that's true of the currency exposure, but your underlying asset can be quite different.
Yes.
Right? I can own euros being long stocks, or I can be long euros owning bonds, right? And those are, different animals with the same currency exposure, right? My currency exposure is the same, but my underlying assets are quite different,
Yep.
right? So I can be indifferent I think we can be indifferent to the currency issue, right? I don't think we should be indifferent to what's the nature of my underlying asset.
Sure.
Right.
And then, so from, kind of going back a little bit too on the asset allocation is, there's 2 strategic asset allocation cycles ago, we actually scaled back the bonds from about 20% to 10%. And that mix of government bonds is 7% U.S. and the 3% to the global aspect of it, and even within that global benchmark, about half of that's U.S. So it's really U.S.-centric within that whole 10% allocation. And, I don't disagree with what you're saying from the yield and negative return perspective, but thinking about how are we trying to protect liquidity from some aspect and get some diversification, and that's where I keep going back to the U.S. bonds, not necessarily non-U.S. bonds, and to eliminate the currency piece of it. And that's what we're looking and seeking to get in that piece of the allocation. The conservative fixed income is a lot more purity, if you will. I'll put it that way, with respect to what that allocation is and why we have it. And if we think about our liabilities being dollar-based as well, if you get it all back to the dollar, then you do have that natural alignment then back to your liabilities. And plus, the government bond index was actually dollar hedged. The managers had the decision to not be dollar hedged, and they were not necessarily dollar hedged. And so that'll show up probably a slide or two that Jeff will touch on too.
One question. Don't we do a fair amount of currency tracking in our derivative program? I'm not sure, but remember going through Russell.
Right,
Yeah.
absolutely.
And wouldn't that be our hedge? And is that why Russell's doing poorly, because we didn't necessarily do it properly? I mean, it's a little over my head. The last time I looked at the underlying holdings there and their program, it was a significant foreign currency.
So within Russell, what you have to do is that you can actually get the market exposure, and you have to overlay that with the FX exposure to match the index. And so it's a passive exposure, it's not an active exposure. That's how Russell would implement. We, the staff, actually implemented back end of August, beginning of September, we added European equity market exposure, but we did not add the euro exposure. But you're right, that if you look in Russell and look through that detail, you'll see that FX exposure, but that's meant really to be passive back to the benchmarks.
Mr. Treasurer, one thing just to be perfectly clear. If we didn't have those currency pieces, we would have something that looks very different than owning the index. Because you would own the index, but then you would have essentially short currency positions without that. So what you see in the overlay is designed to essentially replicate, to the extent we can, the experience of actually owning that index. So.
Active manager, just comment. I want to be clear for everyone here that we're not looking at currency as something, to be ignored. It's rather, who are you leaving that decision with? So we've chosen to leave it with primarily your active manager. So they're making choices, obviously, to hedge. Now, I'll tell you that most non-U.S., active non-U.S. and active global managers do not make material use of hedging. It is one tool that's used, but it's rare to see anyone take on, say, 50% or more of their portfolio on a hedged basis. However, when they're looking at which securities to hold, which companies to invest in, they're looking at currency exposures as one piece of that. They're looking at what the underlying businesses are and their exposures to currencies. So those things are factored in. We've worked with a lot of clients over the years. This is not a new topic. You can think of how many extreme currency environments we've been in. And it's very difficult to consistently add value with currency. There's a lot of managers that have tried to do it and most have failed. You can hire active currency overlay managers. It can be a very expensive, time-consuming piece of the portfolio and has not shown to be a great source of value added. So we've not encouraged the use of that. I'm sorry to interrupt the point you were trying to make,
To
Mr.
put it
Chair.
to put it in perspective, if you just look at the reports of a lot of multinational corporations in the last quarter, the hit that they took to because of currencies, a company like Procter & Gamble or something, it took as much as a 7 to a 10% hit to their earnings because of currency fluctuation. Now, these are highly sophisticated people who operate in the markets every day. So I think for us, it is not unusual that it may present some difficulties from time to time. Now, having said that, I think, currency is, as we've discussed, not exactly a prime investment. So maybe it's something that we should have less rather than more of when it comes to the actual currency exposure. So having said that, it's not an easy thing, and as you rightly point out, it can change dramatically.
Jeff,
Yes, sir.
did you say that half of our global public equity is in non-dollar?
The benchmark.
Of the benchmark?
So, yes.
And
Roughly.
And so does the currency aspect of it explain most of the negative performance?
Yes. If you were to, because I can access the indices, and I can just tell you quite simply. The difference between having the currency exposure and not having the currency exposure is in the neighborhood of 5.5% negative. So if you move this number up, do you think the S&P 500, I think I actually have some of this data right here. The S&P 500 was up 6.1%. The developed non-U.S. markets, without the currency, were up 1.8. With the currency, down 9. Right? Emerging markets, without the currency, down 0.7%. With the currency, down 7.6%. So you strip out that currency piece, and that number rises significantly, which I just want to point out is, once again, consistent with that framework. Because, yes, the growth declined, but the inflation piece fell a lot more. So you would expect that to be net supportive to equities. So let me, I'm sorry, is that responsive to the question? Okay. Let me move on to our performance on an asset class basis. So all in all, at the plan level, we are slightly ahead of our target through December. Again, I just want to remind that the policy benchmark is simply a representation of what the markets have given us. It is down 91 basis points for the 6 months. We're doing a little bit better than that at this time, but still down 81 basis points. Let me steer my comments first toward some things that just haven't worked as well for us. Both the global fixed income and mixed credit portfolios have been points of frustration for us. In the case of global fixed income, this has been due to the fact that the incumbent strategies have been hurt by their high yield, emerging market debt, and currency exposures. For mixed credit, the underweight to the higher quality mortgage-backed securities component of the benchmark, which did quite well in the back half of the year, that's hurt, as well as some of the exposure to the energy sector for those portfolios. Now, at the other end of the spectrum, what's worked well for us, the low beta hedge fund portfolios continues to perform quite well, as has our real estate exposure. Our decision, just as a refresher, our decision back when we started allocating to real estate was to first pursue a more opportunistic, aggressive approach. This continues to bear fruit. Later this morning, or I guess probably in the afternoon, Eric Ravelli is going to continue to discuss the evolution of the real estate program with a manager recommendation. This is
that last chart reflected the overlay in the asset classes.
Correct.
That's the tell.
Correct. This is something we make in order to try to present the holistic entire asset class return. So this is created by David King and Josh Green, who do really an amazing job to get us this. This is simply a different representation of that to show, and we have the hedge funds, the real estate, commodities. Despite the fact it's a terrible market exposure to have, we've done well against that benchmark. Global fixed income, because this is where we have a lot of more credit-oriented exposures that have struggled at the back half of the year. It has not performed as well. Here we have our portfolio exposure by asset class. The bar charts on the right side are new. You can see here that the largest underweights are to real estate and private debt, while conservative fixed income, specifically core fixed income, continues to be the most meaningful overweight to inside the portfolio. As Herschel alluded to, we did add equity exposure during the drawdown in October, and that is part of the overweight to global public equities that we have. This is our traditional waterfall chart. Shows that we've seen in the first half of the fiscal year $510 million of net benefit payments out of the trust, as well as the fact that the plan performance is negative through December. This should look familiar as well. This is the return contribution in dollars from each asset class. Worth noting here is that the largest contributions, in this case both happen to be negative contributors, come from commodities, which is the smallest allocation at the plan level, and something to which we've remained underweight, at just 3% of the plan, and global public equity, which is our largest allocation. So those two sort of explain a lot of the negative contribution. The most meaningful positive contributors are private equity and real estate. Here we see the amount of passive exposure we're currently obtaining through the beta overlay program is roughly $3.7 billion. For context, this is a 40+% reduction from this time last year. And you can see the mix of that overlay exposure on the right-hand side. This is a little bit of a different look. This shows us the amount of the exposure for the asset classes in which we're using the overlay that comes from that synthetic exposure. Over the next several quarters, we do expect further reductions in the use of the overlay for global equity as well as GTAA. We don't intend to store commodities, so we're going to keep that passive. This is my favorite chart. I quite like this chart that David Phillips and our reporting team put together. This shows the historical use of the overlay. So what we see here is there have been three main events that have contributed to the reduction in our use of the overlay. In May of last year, we eliminated the last of our emerging market debt swaps in favor of much lower cost implementation. Then in June, you will recall we funded the BlackRock Global Equity Index Fund in concert with a reduction in our use of the overlay. And then in October, we did the same thing for a little less. The BlackRock was a $2 billion funding. The SSGA Global Equity Index Fund was a $1 billion funding. Correspondingly, we reduced the overlay by those amounts. So let me say a few words here about plan risk. As you can see, we remain in a period of abnormally low volatility. In fact, we're well below the threshold at which we internally escalate the discussion about the plan risk. The current volatility level is 7.68%, historically low, and quite frankly, more than likely not sustainable. It's also not to be confused with being a forecast of future volatility. So this is looking at our actual experience. And here I'd just like to reinforce for everyone that on this page, capital allocation, which is the pie chart on the left, is not the same thing as risk allocation, which is the pie chart on the right. While on a capital allocation basis, we have 41% of our plan invested in global equity, which is, as we all know, well below what you typically see for other plans like us. This still constitutes more than 70% of the plan risk. So in that sense, the returns of the plan are still very much driven by the outcome for global equities, and to bring things back to where we started, to the economic framework. A plan that has 70% of its risk tied to equities enjoys an economic environment that would be characterized by positive revisions to growth forecasts and negative revisions to inflation expectations. So I'm happy to answer any questions at this time. I spent far more time up here than I thought I would. Yes, sir.
I just wanted to ask something about short-run volatility and whether we could come up with other risk measures than the short-run volatility. For example, as a retiree, my outlook is long run and related to the target return over 30 years. And so we have a year now in which our return is below that, but our short-run volatility looks great. So is there a risk measure for long-run risk?
We do have one that we keep here. We tend to obsess about what's happening in the short run, just so that you don't want to ignore what's happening in the short run and focus only on the long run. I think that presented risks for a number of financial institutions in 2008, and they said, according to my models, this isn't happening, but it was. So we are very much cognizant of the long run as well. But the challenge for us is how do we create tools that monitor that in more real time? So, Herschel, I think.
That too, thinking about that, what is the 10-year forecast or the 30-year forecast from a volatility perspective is its forecast. And so really trying to understand where we're at in today's market environment and what that would look like from where asset prices have appreciated and setting future expectations. And we do get a fully updated capital market assumptions from HEK that we actually plug into these models here. But as we think about volatility, and I know in finance sometimes we tend to just kind of blend things together, but volatility, I know there's an argument of is it truly pure risk, and it's more of a measure of the dispersion of outcomes, if you will, and I would say it's more of the recognizing, and as you're measuring it in real time, more the manifestation of the risk that's been experienced. And so the idea of volatility is to give us an idea of the probability of certain losses around certain outcome and events, if you will. But as we think about other risk in the plan, I would say for us, it's really thinking about from, the longevity and sustainability and the health of the plan itself of what happens if we do enter a period of, you don't have to have negative returns, it's just if we don't earn 7.5, and what if we do go through the next 2 or 3 years of sub 7.5 returns, what does that then look like from what we have to earn in the future years to catch up, if you will? And so for us, I think those are some of the other risks, and that's where it becomes really important as we take a look at, we work with HEK on the actuarial side of it as well, when they do the asset liability. So to understand the liquidity of the plan, the projection of what you've experienced and what the new liability side looks like. And so that is looked at quite often. And I know there's a formal every 5 years, I think it is, but we do take a look at that on a more informal or less formal basis year to year as we develop the strategic asset allocation. So we do think about other risk, and I would say, yeah, this is really focused much more on the volatility of the plan, but there are certainly other risks in the market that we would take a look at.
So I'll turn it over to Suzanne for any
Yeah, so
comments?
I don't think it's lost on anyone. What we're looking at for expected return here is pretty modest. And I think if you were to ask 10 different market prognosticators, you would be getting some similar numbers. Obviously, the equity market, as Jess pointed out, it's difficult to extrapolate what we've experienced over the last 5 years going forward, given the economic environments that we're looking worldwide. Bonds are obviously in a situation where expected returns there are quite modest, and then we have inflation at very, very low levels. So all of those are kind of the core engines of the capital markets are not forecasted to be doing terribly well over the next couple of years. So the question becomes, how does one try to get to our expected return targets? Thank you. And you do it through de-emphasizing these core asset classes that have provided very nice engines historically. So relying on alpha and alpha is most predominantly going to be coming through private equity, private debt, real estate, hedge funds, judicious use of active management within the traditional long-only marketplaces, and then using things like private equity to the point that it's prudent. You know, we could certainly ramp up on it to 70–80%. That would look great on an expected return basis, but it probably isn't an appropriate stance for your liquidity circumstances. So it's trying to make kind of that good balance between the public markets and the private markets to try and get us to the 7.5%. The bad news is after you've had nice markets like we've experienced, expected returns aren't very good going forward. That's kind of the bad news. Everyone would like them to keep running, and that would be beautiful, but the economic growth drivers have to be there. And they're, at this point, not horrible, but not strong enough to really sustain the numbers that we're at. On virtually any measure, the U.S. stock market is very close to either overvalued or definitely fairly valued.
Just a question on, for instance, the global equity allocation, and within that, to try to get better returns or enhance those returns, as we all know that over a long period of time, a significant portion of returns in the common equity come from dividends.
Correct.
Are we emphasizing enough in the equity portfolio a little bit of the importance of having the kinds of equities that we can count on for rising dividends? For instance, Coca-Cola had not had great stock performance over the last few years. They just raised the dividend 8.3%. We've seen Procter & Gamble, any number of significantly high-quality companies whose stock performance hasn't been extraordinary, but consistently raising the dividend year in, year out. So my real question is, have we put enough emphasis into those kinds of investments?
Right. So obviously that's one tool that managers are using, and dividends are, in this environment, perhaps a more reliable source of return than expected appreciation in the stock. So that we're leaving those choices up to managers. There has not been an express intent to try and hire managers that are focused on dividend yield, but that's one of the measures they're looking at. So I don't know if you'd like to comment on that.
Yeah, certainly. We have not actually pursued it from an active perspective, and we have moved more of the global equity portfolio to more passive or enhanced indexing strategies, if you will. So it's really to get purely the beta exposure to that market, which will be a primary driver. With that said, we do have active components within small cap, mid cap, and then also within active, or the emerging markets piece of it. So the thing is thinking about that from a long-term factor exposure, the volatility net factor, and as an example of when U.S. Treasury yields went from about 160 to 190, that 30 basis point move, actually, the market sold off. The sector that took the single biggest hit was down about 2.5 was utilities, which are known for dividends. So I think as you get into that competition for yield, you can at some point in time create a little bit more volatility for those things. With that said, certainly over the past couple of years, as investors have for yield, and with the 10-year being where it is, just call it 2 on average, and when you've had 3, 4, 5% for very high quality equities, that certainly people have gravitated towards those. But we have not made that as an active decision ourselves at this point. We've thought about other things.
Yeah, I mean, in fairness to the point, right, if people just see dividends, you wind up with sectors to use, right? But there are ways to constrain it, right? You can match sector level exposures, industry level exposures, and still inside dividends, right?
I do think there's a fair bit of research that, at least, the returns may not be different over time than the index, but they certainly, you can have more confidence in them because it's, you have more certainty around the dividend stream than the growth component, right? And, the value of the confidence around the estimate, right, shouldn't be dismissed either, right? You can wind up with the same return, but still lower vol just because it's more predictable, right? And still be passive at the same time, in that implementation.
So no, that would definitely be a factor we could take a look at, for this annual cycle as well.
So I was going to switch gears. We have our normal report that we provide, and I thought actually today I'd focus more on our private markets report, which we traditionally don't spend a lot of time on. So since Jeff has really covered quite nicely how the big picture is, I'm going to just kind of zip right through here and go on to the next section unless there are questions.
Well, I do have one question for you.
Of course.
It's kind of beat the dead horse about this, but
No.
I noticed that our risk and return charts were all scattergraphs and very helpful, and I would like that a lot. But we didn't do the same thing for just plain return. And I watched the peer groups. I'm not fascinated by the peer groups, but I do watch peer groups. And again, as we go up, we're in the same position as we go down. You know, the market can be minus 1%, and we're in the bottom 20%, and the market can be racing at 17%. And so when do we get the benefit? I mean, how far does it have to go? I mean, do we have to have 2008?
Oh, Lord,
again?
no, let's not wish for that.
No.
So the short answer is
I don't want to
no.
prove a point that way.
No, we are looking at 3 and 5 year scattergrams, so it
Mhm.
doesn't move
Yeah.
overnight. So that's
Yeah.
the basic issue there.
But they chart back. I mean, they go 1 year, fiscal year to date, quarter, year, 3 years, 5 years, the whole bit.
Right.
And we still stay in that same spot.
Right. What you need to have happen is for the equity markets to have a year where we haven't gotten great returns out of it. So as Jeff was pointing out, you do have a little bit more non-U.S. So while the U.S. markets rallied strongly last year, non-U.S. did not, you have a little bit more balance between the two. So you didn't get as much of a pop because of the non-U.S. exposure that you do have. So the private markets helped, but they didn't offset.
So again, we go back to, we have
currency
the theory that makes a lot of sense, and I buy into it, and I suspect everybody here does, but the implementation or the practicality of it, there's always a reason why we stay in that same spot. I mean, it could be currency, this year it could be energy, I mean, there's always going to be a reason for anything,
Yeah.
If I fall out of my chair, there's a reason. So when do we?
Certainly every year, it's not
And
acceptable.
I won't beat a dead horse, but I am just interested to see, when do we pick up the benefit?
Right.
Because we leave money on the table, and we do that because we think it's a good play, and it's, I do that some in my own portfolio. But how far do we go down before we'll start seeing some tangible proof that the portfolio is immunized in the proper way from a significant drawback?
Well, I just want to make sure it's clear. You're not necessarily going down. You're not just going up as much as some other funds are that are more equity oriented.
Well, as we go down, we stay the same. I mean, we're always.
Oh, in the down market.
Yeah,
I see.
So, I apologize.
Yeah.
So,
So-
if you're always in that bottom 20% when you're going up and when you're going down.
Right. No, it certainly is not structured to be in the bottom 20%. It's structured to do well on a risk-adjusted basis over time. So your volatility's been a lot less than your peers. That isn't necessarily great solace when you're not going up as much as your peers. So what we would anticipate is that when you see more sideways markets for more than a quarter or so, that it's something that's going to pay off. So that's exactly the type of market that we're forecasting. To be fair, we had said last year that we did not think the stock markets had a lot of room to run.
Mhm.
So we were just wrong on that. I think a lot of people were surprised at how strong the stock markets were last year. But there's even more evidence today. So I think trying to take a position like that and saying, well, it didn't work out, let's take it off and move more into equity markets would be very ill-timed right now.
I didn't say all that.
I mean, just me personally, right? I mean, I think you got to run a full business cycle, which since World War II, I just pulled up the MBR data. It was 68 months on the upside and 16 to 21 on the downside. So I mean, you run that out, you're talking 80 months of data, right? To really see it, right? So I mean, it's longer than I think most of us, even in this room, are used to.
Yeah.
Sitting around thinking that I'm going to commit to a plan, I'm going to stick to it, and I may not see the results for 8-9 years.
And I'm not saying that it's easy to look at that and say, everybody wants to be in the top quartile. I completely understand that. I think, I'm losing my train of thought. The challenge here is, go back to that chart that Jeff had on how much you have exposed to equity risk. 70% of your return fluctuations are due to how the stock market is doing. If you were more heavily oriented toward that, it would be closer in the 90s. A pretty typical public fund has about 90% of their risk exposure coming from the global equity markets. And that's been a wonderful thing when the global equity markets are go, go, go. We just have to create a program that's better insulated than that. And that's, so what we're trying to protect, and going back to your point, Mr. Wilder, was, let's make sure what kind of risks are we protecting against. One of them is the risk of material downdrafts in short-term periods. So if we, any sort of big correction, and hopefully not on 2008 levels, but the equity markets have corrections. We don't want to drag down funded status because of a single factor in the market. So we're trying to make sure that while you may forego some of that great return on the upside, that we're better protected on the downside, and overall the long term, and it may be a very long term, is really what is going to better protect you. So that's all the theory. But we certainly had very strong equity markets, and you benefited from them, but it does mean your ranking's not as high, and I understand the pain associated with that.
And we actually had that question a little bit earlier this week too, and so I think it's a very good question of course, we have had these conversations with exactly what you're saying. You're kind of, all right, when's the payoff coming? And we think about, as we go back and think about designing the asset allocation and all the things we have to think about, is kind of going back to that asset liability study and where we have from current funding perspective or the future expected fundings and so on and so forth. And thinking about what are the core things. So we know we absolutely need to get growth of trying to earn that 7.5. So we've got to get the asset appreciation. We know that we pay out roughly 4% of assets, $1 billion on the net difference of benefits coming in and going out. So we need liquidity. And then we also need stability, because we think about from where we're at from a funding level perspective today. If those things were different, and so if we were, say, 80% funded, we very well could have a slightly more aggressive asset allocation. And we made the decision, because we could have left the risk in the portfolio, but there was an active decision made by the commission to scale some of that risk back starting probably 4 or so years ago, 5 years ago, somewhere in that time period, because we didn't experience 2008 and 2009, and thinking about that impact and just the benefit structure itself and where we were from a funding perspective, we felt it was more prudent to actually scale back some of that risk and continue to take a longer-term horizon to build back up. So not to try to get it all recaptured within a year or two.
Yeah, I mean, I have a fair amount of confidence in the portfolio. I'm worried about funding. I mean, that we don't manage that. That's somebody else. I'm worried about that because everything I see, everywhere I look, at every plan I examine, everybody's long terms are going, and ours are. And I think we have the obligation to tell the General Assembly what our projections are, because they're looking at $500 million bond bills here. They look at $1 billion transportation bonds. We got $250 million of GO debt fixing to go out the door. But the way the system is set up, if we don't tell them this year, and we say after July 1st, it's 2 years before any corrections are made because of the lag in the law. And then you have to do the study, and then you have to determine the amount, and then it takes effect 2 years after that. Contributions.
Contributions that come out of the actual evaluation are delayed 2 years.
Yeah. So, I mean, that's my big concern is the unfunded liability going the wrong way. We're using 2.75 on $30 billion is our inflation rate. I mean, I can't find that anywhere other than our plan. And, actuaries gave it to us, so that's what it is. But if you don't have confidence in the 2.75 and you look at all this information, how are we going to fund the plan? I mean, we're not going to see it for several years. But if we don't start adjusting our contributions, General Assembly doesn't have any information to adjust contributions. So anyway, thank you. I appreciate it. And
Just a question.
Yes.
One thing that confuses me a little bit is, what if you get into a situation where rates move up and you're able to improve your returns from a cash standpoint through fixed income? Say you get back to a 4% 10-year treasury and you're able to earn 7 or 8% on corporate bonds, whatever it was.
Sure.
And the cumulative returns of those equals or exceeds the amount of benefits that you have to pay out. On the other hand, your appreciation does not dramatically move up. What's the dynamic there in terms of the funding and I mean, as long as you're able to pay those benefits, what happens to the fact that you're not, your unfunded liability is not benefited? How does that work?
Yeah, well, I mean, certainly you get the short-term depreciation from the increase in interest rates. But once you're able to reinvest at higher yields, then you're starting to get, the bond market kind of chugging along again if they stabilize. Really depends on how the yield curve moves, of course. So, looking at something like that, and we have shocked the models to look at what happens in sharp short-term increases in across the yield curve. what does that do to the portfolio? It's whether the other things you have going on within the program are enough to kind of lift up the overall total return. So hopefully it's a small enough percentage that it does not actually cause you to be in a loss position from a total return standpoint. But certainly, they would be expected to earn a negative return over that period. But the good news is once you get through that pain, then we can return to an environment where you are getting some income from your bond portfolio, and then the question is what happens to the actual price component of it.
Yeah, and I would add too that, that kind of gets back to thinking about diversification a little bit differently. And not just asset allocation diversification, so capital allocation, but also that risk perspective as well. And we are certainly not purely balanced in the form of Bridgewater from being the risk parity and completely balanced out for growth and inflation. But if we look back at where we could be versus where we are today, we do have a little bit better balance within those different scenarios. So we would certainly have, so for instance, in a rising rate environment, we have a good bit of exposure to floating rates, so that's going to help. Other assets will definitely sell off as rates go up as well. So you do have some of that balancing effect in there. But to that point, it's going to continue to be a resetting of expectations and asset prices because we still are tilted towards more of a growth bias in the portfolio. Not tilted as much as other pension funds are, but even that 71% factor exposure to the equity markets, we still have a lot of equity factor risk, and I think that will drive returns negative, but not as negative as others. And we have other assets in there that should actually benefit from rising rates.
And one last question along that line, maybe. I know that the new GASB pronouncements talk a lot about money-weighted returns, and I guess that's where they're headed with their disclosure. And I think most of our rates of return are time-weighted, right?
At the plan level?
Yes.
Yeah, I think those are all time-weighted.
Yeah. Do we ever have to worry about those being figured on a different basis? Or?
We have incorporated all of the new GASB requirements, as you know, you asked me about like the depletion date. Because our fund isn't projected to run out of money, we do book some of those different than plans who are projected to run out of money. So I think I sent you some information you asked about the depletion date.
Is the money weighted tied to that depletion rate, or is it separate from that? Because 67 expresses the desire or the mandate to pronouncement to use money-weighted returns. And I don't know that it matters. I mean, this is just way above my head. It's something you do and something y'all do.
I can get back to you on that.
Okay. Because if we're going to end up with some kind of a juxtaposition of two different types of numbers, it may not be far off. I just don't have any idea what they are.
I'll get you some information.
Thank you.
Time-weighted returns are the norm out there in public fund land. I need to know a little bit more about the money-weighted return, so I'll look into that as well. Shall we talk a little bit about private markets? So a meaningful component of the program, we don't often dig into them a little bit, and I wanted to spend a few minutes here today to just make sure you kind of know what the big pieces are that you have here and to talk about their performance a little bit. So we publish this every quarter, and we're actually going to put on your Secure Commissioner website the full report for this quarter. So that should come right after the meeting. That's basically all the underlying details. So earlier there was a discussion about where we see strategic partnership returns coming through. Well, certainly they come through your total fund return, but we have line-by-line items on any private market investments through your strategic partnerships within this report as well. So we're not going to be going through that today because it gets into detail level on managers that cannot be put out in public session, but this is all the underlying data rolled up into the categories. So when you think about your private markets portfolio, and I would point out this is 9/30 data. We don't have 12/31 yet. We'll have that by June. A little slow, but that's how these markets are. You have three big chunks: your private debt, your private equity, and your real estate. And you can see here what we've tried to do is look at things by your current asset value. And then we also have this thing called potential market exposure. And what that is if every manager drew down all the assets at once. That's not going to happen, but we just put that on there so you can see it. So let me just orient you to the things that are on this table, because there's a lot of data here and sometimes it can be overwhelming. So let's start out with that private debt line there. So if you look at, so obviously we have the commitment level. So what dollars have you committed to this market overall? Keep in mind most of these managers pull down assets over the course of anywhere between 3 and 5 years as they find attractive investments. Then they are, working with the underlying investments to add value oftentimes, and then they are starting to return assets to you. So you never have your entire commitment allocated at the same time. The averages tend to be somewhere around 50 to 65% of your commitment is invested at its peak. It really depends on which category we're looking at. So what we have there is unfunded commitments, so that's assets that have yet to be drawn down by the manager. We have here your total contribution, which is basically what has been drawn down. Then we have distributions, what's been given back to you, and net asset value. What are those investments currently valued at? So what we do to get that total value is take your net asset value plus your distributions. So money you've received plus the money that's already in there. We then put that potential market exposure, which is basically if we have all of what's been that's invested currently plus your unfunded commitments, if they are all drawn down, what would that be? And then we have a couple of different things that we look at. So DPI is basically what's been distributed based relative to what you have paid in. The RVPI is basically what is the current value versus what you paid in, and then the TVPI is total value versus what's paid in. So those first two columns together. So generally, when you're investing in these markets, you expect multiples in that TVPI category. So think about where your investments are. You have some that are mature investments that have been drawn down, largely paid back. You have those that are in the middle of their life, and then you have things that are brand new. So obviously you have a range of things, and at the end of the day, if these were all mature and all paid out, ideally you'd love to see things on the 2X category there, the 1.5 to 2X category. But since you have a range of them, we're very happy with where you are right now in your TVPI. We also have net internal rates of return. Net is important here. That means all fees have been deducted from these returns. Oftentimes private markets are expensive. People get a little alarmed by the fees. This is what you have earned from these managers. Internal rates of return are the norm when looking at private markets, because think about what I just described. You have returns that are generated very early in the life of an investment that may be on very little capital, for good or for bad. In the middle of its life, it's the majority of the capital. Those returns matter more because you're getting more horsepower from those returns. And then in the end of its life can be sometimes a very small amount of capital that the returns are being earned on. If you just equal average those over time, it wouldn't be a true reflection of the value added by that manager. You have to have it weighted by the timing of the cash flows. That's what an internal rate of return does. It gives you a true sense of what's actually been earned from the dollars that you've put in that space. So as we look at the internal rates of return since inception, we're very happy with the overall internal rates of return. Private debt around, my eyes are not as good as they used to be, 11.85. Private equity in excess of 13.5%, and real estate is comparable to what you have overall from private debt. So are there questions on those basic concepts as they relate back to the reporting here? So this is just trying to give you some sense of the number of commitments. There's a lot going on here. Staff works very hard on these. Many of these commitments are sometimes with the same manager. It's very common and a nice problem to have in the private equity markets that you can re-up with managers that have been successful for you in the past. So they come out to market oftentimes every 3 to 5 years. If you're very happy with the past fund and underwriting internally and with us is satisfied that the manager is truly a great source of value added, you oftentimes will invest in their next fund. So it doesn't necessarily mean that you have individual managers in these numbers, but you do have quite a few commitments. And this is consistent with a well-run, mature private equity and private debt program. This just shows how it's allocated within the total fund. And just as a reminder, what you probably care about most is this net asset value. So this is basically what it's currently being carried at. Here's your targets. And then this is, again, that potential market exposure. Everything is very close, actually, to the target allocations. We do have a little bit of language here about pacing, and I just want to spend a minute on that. That's not an immaterial effort that we work with staff on. So what we try to do is try to figure out how many dollars do we need to allocate in any given year to ultimately keep you at your target allocations. And the math behind it is more complex than it may seem on the surface. You have to figure out how fast our manager is going to pull down assets, how fast are they going to distribute them, what is that investment going to earn, and what is the total fund going to earn. Obviously, there's a lot of variables there. It's difficult to get them to all align. So we work with staff to do some projections as to what's reasonable there. and to come up with a commitment pace. So as you can see about midway through the line that we're looking at about $600 million in the private debt area for the year, about $750 million for private equity, and about $300 million for real estate. Now, these are not written in stone. These are things that you want to respond to the market opportunities. Sometimes incredibly attractive managers are out there, and you might want to lean in a little bit more to that market, perhaps exceed your commitment pace, and then maybe the next year you pull back a little bit. So there's no reason to ever be shoving that money out the door just to hit those numbers. You want to make sure that alpha is always what should be driving here. You need to have the highest quality managers and the best environments. Now, with that in mind, it means that sometimes you miss it. So sometimes we may go a little bit below the target. Sometimes we may be going a little bit above. It's just a more difficult mathematic equation here. I'm not going to go into this in great depth, but this is something I just wanted to familiarize everyone with, because when you get the full report, you're going to be seeing these sorts of analyses. Here we're looking at vintage year comparisons for private debt. And one of the key concepts in the private markets for diversification's sake is making sure that you're diversifying by vintage year, the year in which the initial investment is made. So why do you care about that? You care about that because people don't know prospectively whether that's going to turn out to be a great year or a horrible year. Let's think back to the year 2000. Everybody loved technology. Wasn't it the greatest thing to invest in? Those dot-com ideas were fantastic. Couldn't put enough money in there. Horrible year to invest. But what's smart is to do it in good years and bad years, to put it in when it's painful, to put it in when it feels good. So you want to make sure that you are always including a well-diversified vintage year exposure here by in private debt, in private equity, and in real estate. So we have it here at net asset values, and then we have it here by potential market exposure. We also have the net IRRs here, and the older they are, the more reliable they start to become. As you look at more recent vintage years, so for example, 2013 has an eye-popper return here at 160. Isn't that great? Well, don't get too excited, because here it's one commitment, and we've only drawn down about $6 million. So they're off to a fantastic start. That's great. But certainly, you can see how those early returns can't just be linked on to the next returns because it's just a small little portion. So if you're midway through the life and it's got 160% return, that's phenomenal. If it's early, that's happy news, but don't get too excited yet. We also break this down by strategy. So one of the things that staff works very hard to do is to make sure that within your program that you have a very diversified portfolio, even within these subcategories. So you can see how it's split out here on the left, the number of commitments and also the different types of strategy in private debt. And these have really evolved over the last 5 or 6 years. There's been wonderful opportunities in the credit markets, but they've kind of changed as the capital markets have been evolving post the financial crisis. So you can see how this breaks out, and then obviously we look at it by the type of investment and the net IRRs. We have the same thing here in private equity, switching gears here, again on vintage year. Very strong overall performance on your vintage years. Sometimes, folks might look at like an early year. Keep in mind this is one commitment that you had back then. So I, always keep in mind the law of large numbers, that you have one investment. Don't draw a lot of extrapolations from that. And again, here we have a very nice 2014 return that is very early in its life. Breaking it out by the core areas in private equity, buyout, energy, fund of funds, growth, secondaries, and venture capital really have pretty strong numbers across the board with the exception of fund of funds, which do tend to often earn a little bit lesser return, and it's a strategy you're not focused on currently. But kind of pulling it all together. Venture and growth equity tend to be the higher performing areas overall. Keep in mind that within these categories you do have a mix of different vintage years, so it's hard to draw big picture comparisons with things such as buyout and energy being more in the less high performing areas for private equity. So your numbers generally reflect that as well. And then finally, real estate. We're going to be talking about real estate a little bit more later. As Herschel mentioned earlier, most of your real estate to date has been in the value-added and opportunistic category, and that's been a good place to be. We've had a very strong real estate market over the last 5 years. We are expecting more modest returns out of real estate going forward, but your managers have done exceptionally well here. So just kind of keeping an eye on the vintage year comparisons again here in the 12 to 14% range for the more mature investments, which we think is very, very nice. You may notice the 2013 line here, again, a single investment at a negative return. That's not uncommon whatsoever in the real estate space. Oftentimes, they're investing in properties that they need to make investments in before they realize any value added. So that's a very normal short-term return to see in this space. And then we break it out by the type of real estate and how it's performed. We have your core at the top. You can see the number of commitments in the opportunistic space are by far the largest. And that's normal as well. You do need to diversify quite a bit there. Core, you can tend to have larger and fewer investments and get a very material allocation. But if you look over at the net IRR lines here, you see some extremely nice returns out of your core, much better than the market overall has realized. Opportunistic, we would expect that to be going up over time. Some of those are a little bit earlier in their stage. Generally, if you were to kind of look at what should be the highest performing, opportunistic generally earns the highest long-term returns in an overall real estate program. It takes a little bit more of risk levels. And I think that is the end of what I was going to add here. So when you get the full report, we will actually have all of this by line item for every single manager in the program. So you can see what year they were, what strategy they are, what all of those different measures are for the manager, and what their internal rates of return are. So hopefully that's helpful to you. And as you look at it, if you do have any questions, please don't hesitate to give us a call. We'd be happy to discuss it with you.
And I'll just add that Ashley will be posting that to the secure website here later today. So this was the more summary version. The details about 100 pages, and as Suzanne said, line by line. So just the earlier question,
Have
we'll
fun.
pick up the co-investments, everything else, and some partnerships as well.
There's also updates on what's going on with the managers. We cycle that through on a quarterly basis. So there'll be some verbiage as well as to what's going on.
Thank you. Anyone have any more questions for Suzanne? If not, then Herschel, did you have something else?
Yes, sir. We have one last topic before, I believe, executive session.
Distribution.
And so the annual investment plan, so that was emailed out yesterday afternoon to all the commissioners, and also posted online. And as a matter of, as it relates back to statute, is that we're required to deliver a proposed annual investment plan by April 1st to the commission, and then the commission needs to approve it by May 1st. So the goal is to, we'll walk through some of this today, but then to give you a period of, if we could get comments back from the commissioners by April 1st, then we will incorporate those into this draft document, and then walk back through those at the April 23rd commission meeting. But we would need to approve it at the April 23rd commission meeting in order to meet that May 1st deadline. But the last thing we wanted to do is give you a week or two to review this and try to get you to vote on it today. So we'll walk through it today and give you a little time to digest it and a comment period as well. So at a very, very high level, so this will be for fiscal year 2015-16. So there are some technical edits in there. And then, get you go to page 89, I think it is. Thank you. So you'll see the red lines, and what was redlined is actually the prior years. This is all the prior years language. And so you'll see not much changes in the overview and the purpose section as it relates back to the SIOP. Also, there is the compliance with the SIOP where you have the policies and things that are things that could have been in the AIP as well. So we link those two together. And then the strategic initiatives where you see some of the red lines, those were the things from the current year that we're in. And then you have the next, starting at the very bottom, you have the next set of initiatives. Now, these strategic initiatives are a combination of things that are across the organization, from an operations and investment, enterprise risk management component, as we continue to build out some of the infrastructure, if you will. I'll use that as a very broad term, at the commission level. And then also we have a couple of different investment things in here as well with respect to some of the partnerships of Idea Flow, looking at longer term investments, the knowledge transfer, and then building out some of the additional asset allocation, investment strategy, research components there. And a lot of these things actually relate back from recommendations from Funston as well. So that's the core of where we're picking up a lot of these things for us to work on from initiatives perspective. We've actually added this year, if I can get you to go to the next page, please. Okay, right there under section 3, we've added a markets update section. And of course this is new, so it's all just a black line for you. I won't spend a whole lot of time here since we've had a pretty robust discussion about what most of this says already. I guess the thing I would caution everyone about is certainly as soon as you write something, as of that date, and move forward a few weeks or a month, and that thinking could have changed. So this will be a point in time discussion. And what we've done is we've gone out to the different investment teams and asked them for their thinking and their ideas with respect to their asset class assignments, and then Ashley Aslan and others pulled this all together into a format. So it's not just what Herschel thinks, it's across the staff. Investment staff is what we're looking at for the markets and specific asset classes as well. And then we've rolled it up into a broad statement here. On the following page, we actually get into, maybe one more page if you don't mind. Thank you. So into the specific asset classes themselves. Again, this is not redlined because we'd have redlined everything from last year to replace it with this. So what we've done is we've actually in the appendix attached the current fiscal year's AIP as a reference for you. But this is all new language for this current fiscal year, or for the proposed annual investment plan. So some of the things within the public equity segment that we'll be looking at will be continue to take a look at from an active perspective. So here we've had, if you can, I can get you to go back to that global equity section, right there. Oh, sorry. There you go. That's okay. So as we see about midway down the page, it says fiscal year 2015-16, those key initiatives. And that's going to be a structure that we've used across these. So towards the end, you'll look at what we'll be able to focus on for each asset class for the fiscal year. So again, from an active perspective, the emerging markets and the small and mid-cap, that's where we have active managers now. We continue to evaluate and review them to make sure we feel that we're getting that consistent excess return above the benchmark. So those are going to be higher fees, and we want to make sure we're getting paid for what they're delivering. And then we'll take a look at international small cap. That's something that we've historically not had in the portfolio, but that's an area where you tend to see a lot of inefficiencies in the ability and opportunity for managers to add significant value over the benchmarks. And then some of the topics that have come up historically have been, the covered call input writing strategy. So we'll take a look at that. And then I know the chairman has actually expressed interest with respect to taking a look at dividend-oriented strategies. So that would be a mandate or an area of research here we could add as well. Private equity, I think Suzanne did a great job of teeing that up. And this year, coming year, we're on pace to, or we'll have a pacing schedule to allocate $750 million for the next fiscal year. And again, the goal is you have to tend to overcommit a little bit to maintain a market exposure, and our targeted market exposure is 9% at the plan level. We'll continue to take a look at buyout. One of the things that I know we've had various conversations at the commission level would be for either venture capital or small managers or smaller allocations. And whether it's a $150 million allocation or a $25 million allocation, the same amount of work goes into it. And so is there a more efficient way, if we continue to believe that there is value in the smaller managers and there's an additional premium, is there a better way for us to actually address that where staff is not having to spend as much time on that? It's much more of a monitoring and oversight, but working possibly with a partner to implement something like that. I don't know what the exact implementation will be, so don't take this as this will be the offered approach of possibly a fund-to-fund structure or some other way to be able to get into the more niche opportunities. So we'll bring that back to the commission once we've obviously we'll speak with HEK on that and think about different implementation methodologies for that segment of it. But obviously the larger allocations will continue with our normal underwriting process to bring that back to the commission as well. So real assets, I'll spend a little bit of time here too, because this will really capture 3 areas of commodities which we've had a discussion about: real estate, and then I would propose actually adding in a dedicated infrastructure allocation. So with respect to the commodities, there's been a lot of work that we've done there. I think about 2 years ago we presented a fund-to-funds type implementation for some of the CTA commodities trading, if you will. And at that point in time, the commission was actually moving away from the fund-to-fund structure. So we elected not to implement, the commission elected not to implement that particular strategy. At that point in time, we had a long-only, pure directional trade-on, if you will, or implementation for the commodities exposure. Since that period, there's been a lot of work to take a look at how can you structure that and make it a little bit better. And so we've done a lot of that work to date. And so some of the implementation things that we'll look at, again, going back to take a look at either more active or more hedged type exposures. And so we'll bring that thinking back to you as well for the commodities perspective. The real estate, again, this is private, so you just don't go out and buy this necessarily like a stock. So you've got to take time to allocate capital. It's going to take time to continue to build that position. We've got a 3.8% position with respect to market weight, target of 5, so we're underweight. Continue to allocate there. As a reminder, you'll know that we've approved 2 fund of ones, one with TA Realty and the other with Greystar, with respect to a build-to-core strategies. A little bit later today, we'll have a presentation on Morgan Stanley Core portfolio or Core real estate strategy. We'll offer that as a recommendation as well. And that goes back to, we had 11+% net IRRs from our real estate allocation. And when the commission started investing in real estate, the financial crisis had happened. And so we were buying into more distressed, more higher risk, but the fact the asset prices had been depressed, you actually eliminated a lot of the price degradation, if you will, that could potentially happen. So the commission actually went more value add, opportunistic, and now we're in the process of actually going back to a more balanced approach of having core, which tends to be your much more stable assets and income producing, to be about 50% of the portfolio. That will take 3, 4, 5 years to actually make that transition. And so that's what's going to be happening over the next 5 years. So this is a longer term transition plan. Another area that we'll actually take a look at that's actually much more liquid would be possibly a public REIT strategy as well. Now that tends to have a little different volatility profile because it is more liquid, but we'll look at bringing that to the commission over the coming year. Infrastructure, this would be something new. We've looked at it in the past and have never gotten to the point of pulling the trigger and moving forward necessarily. But the whole idea here is to actually think about the duration of our liabilities and thinking about, are there actually very solid assets with very stable, reliable, consistent cash flows that we can match off with some of those longer duration assets. And these would be, tend to be longer term holds of looking at possibly 15 to 20 year hold periods, if you will, for some of these assets. So we're looking at what makes the most sense from an implementation perspective there and who some of the partners would be to be able to fulfill that. And our concern is that, we see this as a much longer term asset class. And if you go into the traditional fund structure where you have the first 3 or 4 years of investments and the next, 4 or 5 years is harvest, then you could be in the position to own some really good assets, but you have to sell them because of the term structure for the commingled fund. And so our thought is, can we partner with other people who want to hold these assets, great assets, for a much longer time period? We'll bring that back to the commission as well.
What are some examples of investments that would be in that asset class?
So you could look at, going back to the infrastructure thing there, we've talked to folks who actually have wind farms. We talked to people who actually have hydroelectric production, other power generation. Other things that people tend to think of would be toll roads as well, airports, et cetera. But we want to be very specific with the types of assets we would actually put into the plan. So. From an opportunistic, this is really where you get the multi-asset GAA risk parity and the low beta hedge fund allocation. Right now we have roughly a $700 million passive allocation in the GA space, global asset allocation space. We're going to look to redeploy that capital slowly as we do find other multi-asset strategies, possibly taking a look at other unique return streams of possibly negative duration. So if we do get into a rising rate environment, that would be a strategy to help hedge against against rising rates, and that would be managed on an active basis, so it's not just a pure negative duration play. They are seeking to add longer term returns as well. So that would be an example of some things we're looking at. Low beta hedge funds, we've done a lot of work historically on that. Again, starting back in 2009, we started that conversion from hedge fund to funds, and we have just a small amount of hedge fund to funds right now that are still in liquidation, but the vast majority of that portfolio has been converted to direct exposure. And so we'll continue to work around the hedges to actually improve that portfolio and to optimize that portfolio as well. The plan level has a 15% cap for all hedge funds. We have an 8% target for low beta hedge funds. So we can take hedge fund exposure in other directional parts such as equity or credit parts of the portfolio as well. Diversified credit, this is an area we need to continue to work on right now. The active management component here has not been as strong as it has historically, so this past year is an area that we've experienced some weakness in the portfolio. Steve Marino and Ashley Aslam are doing a lot of work in this space, as well as I believe James Wingo is assisting them here too. But the idea is to take a look at allocations to specialist managers who have the skill set to actually underwrite specific credits from a bottoms-up perspective for high yield, bank loans, and structured credit. And then we will complement that with managers who actually have more of an allocation strategy to go across those spaces as well. So that's the idea, is to find a way to be able to have the flexibility, the bottom-up security analysis, put it together to get a much more efficient credit exposure for that space. EMD, we talked about, it's currently a 50-50 blend between local and USD. And as we go back, Brian Moore's been doing a lot of portfolio construction work and taking a look at the active passive decision here. And there are certainly periods where active management pays off, and there are certainly prolonged periods where you wish you would have just been to the benchmark. And so we have a combination of active and passive implementation here as well for the emerging markets debt piece of it. So we currently have 2 managers there on the active space, and then we have the passive implementation. Private debt, we had carved this out from private equities. We think it does have a different risk-return profile than the equity piece, and so we just wanted to create a little bit more transparency to the debt or the credit piece that we actually have. So we're slightly underweight here, so we're working to get that back up to weight. And this is actually where you'll work with managers who are actually creating the direct credit arrangement with the underlying company. And so the good thing there is you can actually have a lot more control over the terms and conditions and the covenants that get structured for that specific deal. Also, with these, you tend to be much higher in the capital structure, senior. So if something does go wrong, you're the first to get paid, and you tend to have a much higher recovery value. Additionally, because these are private transactions, you tend to get 100 to 200 basis points more return over traditional high yield or bank loan market because it is a private deal. Conservative fixed income, we've hit on this a little bit earlier, but Mr. Berg will have some recommendations in executive session with restructuring this. And this really gets back at the essence of some of the earlier conversations of how do we go about not eliminating an asset class for global bonds, but giving managers the ability to allocate completely away from it as well, and some of that flexibility. Because at some point in the future, you will say, hey, weren't we invested in global bonds? And so we don't want to completely eliminate that, but now there are probably much better investment opportunities. So I think this is more of a portfolio structure component that we'll address here in a few moments. Short duration and the cash allocations. Again, we've moved to having the Russell overlay component is fully collateralized with cash and short duration. So you have that matched up as well. And the idea here is that there tends to be a financing cost, if you will, that's the term used, but a cost to actually having the swaps in place. And the idea here is to actually manage a cash portfolio to offset or overcome what that cost is to get you back to benchmark. So when you put the allocation of synthetics overlaid with the cash and short duration portfolios, you get back to what the benchmark looks like. And so we manage a significant portion of the short duration as well as the cash pieces internally. We'll continue to do that, and also this is a great buffer to have from liquidity shocks as well. So we have a significant amount of liquidity internal. Securities lending plan, I know there's been a lot of discussion over the past couple of years, and it's time for us to really take a deep dive and say, is there a better implementation, a better way for us to actually use securities lending, and then implement that. And if we feel it's really just too much risk in the securities lending pool, then maybe we make a different decision that we just continue to suspend and hold back from doing securities lending. But again, that would be a commission level decision, but we'll propose a couple of different things for the commission here in the coming year as well. So, and then this was just for your reference, the current fiscal year's plan, if you wanted to do a comparison. So I'll stop there.
Only question I have is the SIOP. Since we incorporate some into the other, do we try to do these at the same time, or?
So we've updated the SIOP, was approved by the commission November 20th. And if I get someone to.
We don't have a statutory period on that one, just once a year?
Just once a year, but not a specific date.
I got you.
And can I get you to scroll up, I guess, yeah? Or, well, either way. Trying to get to the very first part of the first page after that, yeah. Okay, so right here is, I think it's about 2 years ago, we had removed a lot of policy language from the AIP and put that all in the SIOP, per the statute allowing that, and then we put in the language that links the two documents together. So while they have certain different objectives and goals, they're linked. So while this is the investment plan, we still need to conform to the policies and procedures in the SIOP.
In terms of the calendar year timing of things, when does the staff begin discussing asset allocation, and when does the commission have its input into asset allocation prior to the SIOP decision?
Sure. I'll say staff, we never really stopped discussing it. We never do. We have weekly meetings where we're discussing it, or more formal every other week where there are meetings that we discuss it from an investment strategy perspective. Are we in compliance with the guidelines, et cetera? There are different things that we want to do. From the strategic, so that's much more on a monitoring basis, if you will. I shouldn't say daily, but at least weekly to bi-weekly basis, if you will. But it's always being discussed. And David Phillips is, focused on that with his team, with UAE and everyone else, and they constantly look at that. From the strategic asset allocation component to it, we actually review that and present that in the commission yearly. And then there's usually the presentation period, and then depending on the meeting schedules, a couple of month lag that would actually come back and approve it. And so there was a discussion on that. I think it was either September or the early October, I guess it was early October meeting, because that meeting got pushed back a week. And then there was the approval of it in November 20th. So that's usually the way we'd work with that. But at any point in time, that document can be amended. So we're not, once it gets formalized, we're not just stuck holding the document. We can amend it anytime.
Yeah, one of the Funston recommendations was that the commission spend more time on strategic aspects rather than on operational. And seems to me we did not have extensive discussions about asset allocation during the past year in terms of proposing changes or that sort of thing. And I just wondered if do you anticipate the changing economic conditions to lead to more discussion of that, or do you see more of a stable pattern of the asset allocation?
Certainly I would welcome comments from the chair and the vice chair and the executive director, any other commissioners with respect to preferences there as well. And, it's one of the things that, as we think about the evolution of the commission, and where there's minimal staff, commissioners were actually involved in due diligence. And now the commissioners are no longer involved in the due diligence aspect of it, and it's relying on HEK and staff to bring the recommendations. And so we can see that constant change and that evolution, if you will, of the commission. And then, the big thing, and you'll pick up on some of these strategic initiatives, is actually fully building out and flushing out some of that operational component and infrastructure component, so that's very important. And then as we continue to evolve, I think that, I would expect at some point in time that will be the dominant theme, is talking about what's working in the portfolio, what hasn't, where do you want to go from strategic, what's happening in the broader economy and things like that. So I would see that becoming more and more dominant theme. But as a CIO, you'd probably expect for me to say that, but obviously there are other relevant topics we need to bring up and talk about too. So, so I'm not sure if anybody has other input on that.
Well, at the same time that Funston urged us to be more strategic, they also urged, and I think the commission heard, and we adopted the new formulation. How we'll have this asset class is going to have X percentage of the portfolio. We're going to give y'all more latitude about rebalancing and restructuring all of that. So, except in the broadest sense, a lot of that boat's kind of sailed, because you're really not going to say, well, okay, we're not going to do any equities anymore, right? I mean, you're going to always have that big component there. And you've got the ability to operate inside that box. We've effectively done that for all of them. So really, am I right about this? The questions we're going to be answering
are important, but they're going to be a whole lot fewer than they used to be. Whereas we might chime in, oh, we've got too much missed credit. Well, that's all in that big bucket now. So as long as we're looking at it in the bucket way, it's not going to be as nearly as granular as I think as it used to be. And that might be a perfectly fine thing, but.
So while there are certain delegations of authority such as rebalancing with respect to the limits and the guidelines set by the commission or approved by the commission, so we do have that. Then also within some of the strategic partners, there is more delegated authority to the CIO with respect to our process. The final decision for, say, new manager still comes back to the commission for that. So that's still in place. So that's something that hasn't changed from one of the recommendations from Funston. But I do think that, to your point, that as we start having enhanced reporting and walking through, say, for your example, within credit, that we can take a deeper dive in credit and start thinking about what's happening in the credit markets and, you know, how much floating do you want to, and how much credit exposure and different things like that, and what are you seeing, and gather, you know, input and different things like that. And at that point in time, while we had a great discussion earlier about, you know, the currency piece and the global bond rates, would that be a decision the commission would want to take up and say, at this point in time, we'd prefer not to allocate to global bonds? At some point in time, we may in the future. But I mean, that's, like we had in discussions earlier today, I think that's really where we'd continue to gravitate towards.
Yeah, but I mean, I think in terms of the process, which I think is a little bit, you know, to Dr. Wilder's question and Treasurer's comment, right? We've created very big buckets, right? And I think rightfully so, because otherwise it gets too granular, you know, I don't want to say too documented, right? But you can't function. And yet implementation choices are what I would call strategy diversification, right? The differences can be quite substantial, right? Like within global equities, Ed was asking the question, what about dividend strategies, right? Well, they're going to have a certain tracking and cyclicality around, you know, that as a passive allocation. Or I could do merger arb, which is an equity-based strategy, but it's going to behave like a fixed income, you know, type of thing, right? So, I mean, I think we ought to spend some time on those types of questions, because I think not the specific implementation, but the general implementation of what I would call strategies within a very large bucket, without necessarily changing in terms of paper and actuarial planning the big bucket, because I think there's potentially a lot of value add. Like, I mean, you were talking about the dispersion between international and U.S. It's quite substantial, like even on a pretty long-term basis at this point in time, right? You know, so if that just reverts, I mean, you're talking about 300 basis points a year, right? You know, that it would have to recover over a multi-year period, because, I mean, the rolling underperformance now is out to about 20%, but it's gotten wider, right? I mean, it's been 40 before, and people have got to say, all right, can we commit to that and hold that, and, you know, because it might take 5 to 7 years, right? And staff's got to know where I think our tolerance is to tolerate that within the idea of asset allocation hasn't changed at that high level, but that implementation choice is going to lead to a certain amount of volatility, right? And, you know, I think that's where us giving some guidance on what is that risk budget around that comfort level, you know, really going to be, because we have gone to very high level, you know, asset classes that have very big buckets, and so are unlikely to change much no matter how many ways we run the models, right? You know, commodities being the best example of that, right? I mean, the implementation choice was everything, right? I mean, obviously, y'all know my preference for CTAs. We extracted positive returns from commodities, right? You know, but that's an implementation choice within that big bucket. You know, so I think those are worthy questions, but they wouldn't necessarily fall in asset allocation models as we're traditionally practicing them. But I do think they're worthy of board level discussions, right?
Maybe that would be something that we could build into having that discussion, you know, kind of that within the kind of the strategy within the asset classes, build that discussion into annually into the retreat. I mean, I think that would be a good forum for that, and then we just build that thought process into that, you know, in June when we have, you know, when we're together, that we have more of that kind of in-depth discussion. So, I'll just put that out there as a consideration, is to build that as a process, build that into our retreat, and have the time to get into a little bit more strategic discussion within the asset classes and get the temperature of the commission as to where your risk tolerance is in regards to that.
You know, it's a perfect example of doing something well, and the way we do that now is done well. But it's like the old strategic partnerships. We needed those, but you couldn't really implement them in a real life term like we wanted. I don't think anybody ever thought we did. But also because it's kind of a self-contained operation, we have to kind of go and think about something, like what's really happening way down there, and think about it, because otherwise staff is dealing every day, right? I mean, they're trying to rebalance, they're looking at this stuff, but they're not thinking from our perspective. So again, it's like strategic partnership, a good idea, how you make it work, and then you have this idea of increased flexibility for staff to be able to manage the broader classes, but it never, it's like it just fails to bubble up. So I think we're gonna have to really, maybe address a sector or a quarter or something, I don't know, somebody to force a conversation about those buckets. But otherwise, we'll just get lost in the day-to-day.
And this is, a conversation, a similar type of conversation that Herschel and I have been having about, especially when it comes to the strategic partnerships and the co-investments, is to make sure that we're, because of now that we've achieved this sort of higher level 10 to 30,000 foot view for the commission, to make sure that we're bubbling up the things that, and trying to strike that appropriate balance so that, that making sure that we're bubbling up those things that you need to know and giving you that type of information on a more regular, ongoing basis. So, and I think that's also having that more strategic asset level discussion is something that is also something that we need to think about as well.
The flip side of that, though, if it becomes all staff driven, then it's all staff driven. We're effectively
Sure.
answering questions for staff.
Right.
Believe me, I do that all over the place. So I'm
Right.
in that rat trap and that little mouse thing. So again, we'll talk about it later, but
Yeah, and I think it's just striking that appropriate, given the progression of the kind of the role of the commission.
it's a good problem to have.
Yeah, and striking that appropriate balance. So it's something that we're mindful of and want to make sure that we're doing correctly from our perspective as well. So, thank you, Mr. Chairman.
Mr. Chairman, that concluded my remarks for the AIP, and just again as a reminder, we'd respectfully request that commissioners give us feedback by April 1st. Ashley Aslan or myself will collect that feedback, and then about 2 weeks before the next commission meeting, April 23rd, so I guess that'll be about April 7th, 8th, somewhere in there, we will post a red line version so that commissioners can see.
Commissioner feedback by April 1.
April 1, yes, sir.
Any other questions for this gentleman? Herschel, anything else?
Mr. Chairman, I think that's it for us right now.
All right.
And I think that the next item, Mr. Chairman, on the agenda would be executive session. So,
all right. So we need a motion to go into executive session. Second. All in favor?
Aye. Break for a minute.
Sure. Yeah.
Yes.
And just we're taking a 5-minute break, and we'll go into executive session. And the first order of business will be
W.L. Ross.
W.R.
W.L. Ross.
W.L.
Ross.
L. Ross.
Yes, sir.
Mr. Chairman, I'll ask Brian Moore to make that presentation.
Okay.
Great. Thank you, Herschel. So I'm going to be up here presenting the W.L. Ross memo. It's been provided to the commissioners on watchdogs. And just to give some additional background, in 2012, the commission approved to engage W.L. Ross in the management of the conduit vehicle. W.L. Ross was chosen for their depth of experience across a wide range of sectors and industries. And with regard to the hiring motion, it had failed to expand the investment scope away from financial services and real estate investment, which was the initial scope of the Ranieri conduit partnership. And so unfortunately, the motion technically, because it didn't list a broader sector focus, the staff felt it was appropriate to ratify with the commission the understanding that the scope and the investment focus is much broader than just the industry verticals of real estate and financial services. So I'm happy to take any questions at this time. I believe Robert has a motion that would reflect this change.
Yes. Mr. Hitchcock and Mr. Chairman, there's a motion at the bottom of page 2, top of page 3 of the open session packet.
Yes. Now go ahead and read it if you'd like, Mr. Chairman.
Yes.
In regards to WLR, adopt the recommendation of the CIO and the Internal Investment Committee with regard to the WLR SC Financing Conduit LLC to ratify and confirm the Commission's intention that the WLR SC Financing Conduit LLC be available as a potential vehicle for investments, including but not limited to limited partnership interests, limited liability companies, operating companies, co-investments, fund of one accounts, and separately managed accounts in a variety of industries and strategies across WL Ross and Company LLC and its affiliated companies, including but not limited to Invesco Limited, as capacity within the existing WLR SP permits and utilizing the current approval process for investments within strategic partnerships, and authorize the chairman or his designee to negotiate and execute any amendments to the WLR SP documents that may be necessary to reflect this ratification, and to make any other necessary technical updates or amendments to the constituent WLR SP documents upon approval for legal sufficiency by RSIC Legal. That's the motion.
We have a motion to approve.
So moved.
Second?
Second.
All in favor, please say aye.
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 It's unanimous.
It is carried. Next.
Next would be Pyramus. Pyramus Asset Management Contract will be next.
Steve Marino, who will present the contract renewal for Pyramus.
All right. Good afternoon. Today I'll make a recommendation to renew the investment management agreement with Pyramus Global Advisors Small Cap Core Strategy. For a little background, here you go. It expires May 2015, and it'll remain in the bank or in custody of the Bank of New York. No, speak up. I'm sorry. For a little background, Pyramus is a separately managed or a separate business unit of Fidelity, established to serve institutional clients. This small cap core strategy seeks to outperform the Russell 2000 index on a net of fees basis over a 3 and 5 year rolling period, which they have, and I'll later illustrate. Strategy focus on a fundamental analysis coupled with constrained portfolio management and construction process to remove unnecessary risks, utilizing a tracking error target of about 100 to 175 basis points. And we've been invested with Pyramus since 2005. Ethan Hugo is the current portfolio manager and has been the primary on the account since 2010. So broadly at the strategy level, turnover has been low, but I would note that in December of 2014, the head of fundamental research retired and was replaced by the head of quantitative research and investment risk. We don't find this to be material, but we'll continue to monitor any other departures at the strategy or firm level. In addition, the strategy did add a new technology analyst from the Fidelity research platform. The process has remained the same, and they retain their boutique-like structure that leverages the benefits from Fidelity's deep research staff. Performance has been great over the time period, with their average excess returns greater than 300 basis points over the 3, 5, and 10-year periods, which I'll illustrate on the next couple of slides. And from the strategy or portfolio fit perspective, the strategy enables us to implement an overweight to small cap equities, which we believe to have greater inefficiencies and offer greater opportunities to generate excess returns. The price remains the same, 60 basis points, and the fee schedule is reflected in the memo. During November, I would like to note that staff did redeem $150 million for normal portfolio management and rebalancing purposes. The following 3 slides illustrate Pyramus's performance and attribution of their returns. The chart at the top illustrates their rolling 3-year excess return relative to the Russell 2000 benchmark, which for the better part of the time period has been greater than 200 basis points with the exception of the financial crisis, illustrated here. As of 12/31/2014, as noted below, the 3, 5, and 10-year numbers are in excess of 300 basis points. In addition, on a peer ranking, the strategy is top quartile over the 3, 5, and 10-year periods and has outperformed the benchmark in all measured periods as of 12/31. And lastly, just kind of looking at the sources of returns, this is a chart of the attribution of the returns from sector allocation, which is in the blue, versus security selection in the orange, and cumulative performance over the past 3 years. And what you'll notice is that the overwhelming majority of their returns are generated through their ability to pick securities, which is what we hire them to do. So in closing, very briefly, just making a recommendation to renew the investment management agreement that expires May of 2015 in the custody of Banking New York Mellon. And at this point, I'll pause and take any questions that you may have.
Fees in line? I know they've been a long time, but
Yeah, they're in line with industry peers and taking away some of the, with the normal rebalancing and taking away, kind of took away some of our, I would say, negotiating power in that.
Thanks.
Yep.
Any other questions for Steve? Not?
Motion, Mr. Chairman.
Hitchcock, motion.
Yes, sir. Pyramis Asset Management and Contract Renewal. 1, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the memo dated February 26, 2015 regarding Pyramis Asset Management. 2, authorize a renewal of the Commission's existing contract with Pyramis Asset Management for another term of up to 5 years, and authorize the chairman or his designee to negotiate and execute any necessary documents to implement the renewal of the investment as approved by the Commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the Commission on May 1st, 2014, or as the review period may be amended or superseded by the Commission. That's the motion.
All right, have a motion to approve.
So moved.
Second. Motion's been made and seconded. All those in favor signify by saying aye.
Aye.
Aye?
Aye.
It's unanimous.
Next will be Pine Bridge.
Next, Mr. Harper.
Sir, Mr. Chairman, next is for bank loan strategy, senior secured loan, and Steve will present this as well.
So this is a recommendation to hire Pine Bridge Investments to manage a senior bank loan strategy with an estimated initial funding of $400 million in a separately managed account, up to 4% of plan assets. During the course of this presentation, I'll discuss the goals and process of the search, introduce Pine Bridge, describe the investment rationale and key differentiators, illustrate the strategy's fit within our portfolio, identify a few risks and our comfort with those risks, and lastly, discuss fees and pricing. So before we jump into all that, just want to do a quick review of the mixed credit benchmark, our asset class plan, as well as briefly discuss leverage loans in the context of a credit portfolio. We have a target allocation of 6% to mixed credit, and the policy benchmark is composed of equal weights of high-yield bonds, levered loans, or bonds, loans, and structured credit. We view the asset class, both the asset class and managers, in 3 distinct categories. So specialist managers, which are identified in these boxes here, high-yield bonds, loans, and structured credit. Multi-sector managers, which will manage across the 3 various sectors of credit, and then opportunistic or hedge fund-like structures. We're currently in the process of negotiating an IMA with Guggenheim for the multi-credit strategy. We'll begin receiving cash flows from the hedge fund opportunistic portfolio as that program winds down. We'll begin a structured credit search for the second quarter of 2015. And lastly, what we're talking about today is the bank loan allocation or leverage loans. Very generally, leveraged loans are loans that are made by commercial or investment banks to below investment grade companies, and the proceeds are generally used to finance M&A transactions, recapitalize balance sheets, refinance existing debt, or just fund general corporate and project finance spending. Demand for these offerings primarily consist from finance companies, institutional investors, collateralized loan obligations, or mutual funds. Leveraged loans benefit a credit portfolio in 2 different ways. One is by defensive positioning, and the second is interest rate risk mitigation. It's illustrated in this chart below. Loans sit at the top of the capital structure and are typically supported by collateral of the business. They benefit from having first priority to the claim on cash flows as well as collateral of the underlying businesses in the event of default. Loans also provide an interest rate hedge through their floating rate structure. As rates rise, coupons are priced LIBOR plus a spread and will increase with the interest rates. And on average, they have a floor of 100 to 125 basis points. So in this search, we sought to identify managers that could add consistent excess returns in the large cap market of the levered loan market as a complement to Guggenheim's middle market strategy, who can add value through investing in high yield bonds as an additional source of excess returns. Firm with capabilities to invest in European credit and to do so at a competitive fee. And while this allocation will broadly be defensive in nature, we believe this to be an area of credit that can add attractive excess return through fundamental security selection in both up and down markets as well. So we identified 6 managers through internal analysis and HEK's buy list. We performed initial phone screens and also in-person meetings. We followed that with additional strategy and portfolio analysis, leveraging HEK, and also conducted an on-site visit. Our internal operational due diligence reviewed the operations and the strategies buy rated at HEK. So PineBridge is a global investment manager that manages approximately $78 billion across fixed income, equities, alternatives, as well as asset allocation strategies. $10 billion of which is within the leveraged finance group, which is where the levered loan strategy would sit. They were formed in 1996 as the investment advisory business to AIG. They were purchased by Pacific Century Group, an Asia-based conglomerate, in 2010 from AIG. They benefit from the breadth of a large institutional organization with 225 investment professionals across 21 countries, but also the nimbleness of a boutique within the leveraged finance group, only running the $10 billion. I think it's important to note that the firm benefited from AIG's resources to grow the business to this scale and has utilized their extensive platform to help share information across regions as well as asset classes with the intent of leading to better investment outcomes. They accomplish this through monthly investment strategy meetings, fixed income asset allocation team meetings where they get asset class, sector, and geographical heads together to discuss themes affecting their regions and asset classes. We observed a daily credit and trading meeting as an example of this, and it was very impressive, not only from the content level, but also from the efficiency in which they exchanged information across offices in LA, Houston, New York, and London. The Leveraged Finance Group is run by co-heads Stephen O. and John Lapham, and if this recommendation is approved, Stephen O. would be the primary portfolio manager. The two have run the team together since 2000 for approximately 15 years. The team consists of 21 members across research, portfolio management, and trading, average 19 years of industry experience, and 10 of that has been at PineBridge. They are capital structure agnostic, meaning they look across high-yield bonds and loans, as well as up and down the capital structure for the most attractive relative value and risk-adjusted returns. Dedicated European staff that is in Europe and also have dedicated legal resources in both the U.S. and Europe, which is important, especially in this space due to the document-intensive analysis of investing in loans and high-yield bonds, working through defaults, bankruptcies, and restructuring. We believe PineBridge's experienced team and their disciplined investment process, as well as their strategies fit within the mixed credit portfolio, support our decision to make this recommendation and separated them from other managers that we reviewed. Senior leadership at the Leveraged Finance Group averages 27 years of experience, and they've instilled a deep credit culture. Process is rooted in its focus on downside protection, which is illustrated through their below-market default rates, above-market recovery values in the event of default. We cited a disciplined investment process as a differentiator and thought an example would probably best describe at least a piece of this process. All managers that we met with would write a credit memo, review them, and recommend to include or not include a credit. But I guess we thought separated them was their commitment to managing the downside risk, and this was illustrated by their credit impairment catalyst triggers, or CIC triggers, which is an internally developed metric, as well as their continuous improvement through their annual lessons learned review. A CIC trigger is a data point that is memorialized in a credit memo. They're identifiable, they're capable of being monitored, and typically non-financial related. So an example of this would be Carroll's Restaurant Group. They're a publicly traded franchise operator of approximately 10% of Burger King stores. So when Carroll's reports their earnings, it gives insight into the health of Burger King through their sales growth, their same-store sales growth, or new sales growth, and can provide a leading indicator into, or ultimately, Burger King's credits. Other indicators would be commodity prices. They look at rig counts, well counts, permits, day rates, et cetera, within the oil complex, or aircraft capacity utilization or regulatory changes within the airline industry. The analysts are responsible for monitoring these triggers, and they must provide an immediate update to credit committee if the trigger is violated, as well as a re-underwriting of the credit. What we also thought to be one of the most important or impressive parts of their process was their ability to adapt, but also to implement change. The team performs an annual lessons learned review in which the PMs, analysts, and traders are forced to review their worst decisions throughout the year. Through this process is where the CIC triggers became a big piece of their underwriting framework back in 2003, when management believed they could have avoided additional credit mistakes. From a portfolio fit, PineBridge should benefit the mixed credit portfolio by reducing volatility, specifically downside volatility, which I'll illustrate in the next few slides, and as well as doing so at a very competitive fee. And lastly, PineBridge's performance and sources of their returns has been strong over various credit cycles, and we believe the processes and people in place support this expectation going forward. All right, so moving on to performance, I guess the standard disclaimer that we all know performance is not indicative of future results, but I do think it's important to believe or to look at their historical performance as well as the attribution of their returns going forward to describe how PineBridge has added value relative to the benchmark. And in my opinion, as a result of their focus on downside risk mitigation as well as fundamental credit analysis. So we'll take a quick look at both quality and default, which I believe are two main sources of return. The first chart in the bottom left-hand corner over here illustrates their average credit quality back through 2007. And what you'll notice is that prior to the financial crisis, as illustrated by this white line, the average credit quality migrated higher, so migrated to higher rated securities. When the crisis hit, higher quality securities with greater liquidity were the first to be sold off. This pushed prices of high quality loans into the 60 cents to the dollar range. Management, I believe, relied on their issuer credit analysis and the view that these loans were healthier than reflected in prices, began purchasing more of these previously higher quality issues. That resulted in relative strong performance in 2009 when markets recovered, which you'll notice here in this chart on the bottom right in 2009, nearly 800 basis points. I think it's important to note here that they made the right call on credit twice. While the first didn't work out, mainly due to the unique situations of liquidity during the financial crisis, they relied on their process and also their commitment to fundamental credit underwriting, and they were rewarded for it. The chart at the top right looks at their default rates, and so what the chart illustrates is their losses from defaults, which takes into account default rate times 1 minus their recovery value. So said a little bit differently, this metric isolates their total loss through the entire default cycle. So through default and then on the back end recovery value. The blue line here illustrates PineBridge's experience. The red illustrates the benchmark. And the green illustrates the relative outperformance of PineBridge versus the benchmark. And the key takeaway here is the correlation between the outperformance of having below market default experience as well as the annual excess returns. And note that in only 2 periods over the 13 years analyzed were they below the market. From a portfolio fit perspective, the mixed credit, adding PineBridge to the mixed credit portfolio should benefit the portfolio in a historical perspective by increasing the portfolio's returns, although marginally from 50 to 51.8%. This is cumulative return over the period. But mainly reducing volatility, which is mainly attributable to the downside volatility. So standard deviation of 4.3 to 3.8, but the downside deviation of 3% to 2.4%. In addition, it reduces the tracking error of the strategy or the deviation from the benchmark from 3.5% to 2%. And as a result of all this, it increases the Sharpe ratio, the risk-adjusted returns, from 2.2 to 2.6, and their information ratio, or the consistency of their excess return generation, from 1.6 to 1.9. While reviewing this manager, we identified a few risks and our mitigants to these risks. The first being firm AUM growth at the leveraged loan strategy. Has been slow, but we believe it could ramp up as they've increased their consultant relationships and also placed an increased effort to grow their institutional asset base. We will plan to regularly revisit their participation rate in new deals as an indicator of their capacity constraints. Currently, they participate in 1 of every 4 deals that come to market. If that were to move to 1 out of every 2, that would be cause for concern. HEK and staff believe the firm is properly staffed, however, for growth and can maintain their excess return profile over the next 5 years. Should they grow assets meaningfully. From a market perspective, we've been in a period of fairly strong credit fundamentals over the past 6 years. Default rates have been low and are projected to remain that way in the 2.5% to 3.5% range. And should default rates increase, loans will provide a defensive position within the mixed credit portfolio. In addition, we're proposing guideline changes or guideline flexibility to allow for quality tilts when appropriate, as seen in 2007, 8, and 9. And lastly, the sale or a potential sale by Pacific Century Group, and we'll continue to monitor this relationship. A little bit on Pacific Century Group. They have made long-term buy and own decisions or investments, but have at times exited these positions as a source of returns. Their previous exit of a similar entity was PCI, Pacific Century Insurance, which is an Asian life insurance company. It was purchased in 1994. They were taken public in 2000 and exited in 2007. So this was a 14-year hold period, and over that time, PCI's assets grew by 7 times. In addition, we get comfort in knowing that PineBridge employees own approximately 20% of the business and have the opportunity to earn up to 30% of the business. And also in the initial sale process, the Leveraged Finance Group was highly involved in the sale process from AIG, helping to identify potential buyers as well as negotiating for their autonomy. Moving on to fees, we believe we negotiated a competitive fee structure for the size of this account. HEK and PineBridge disclosed their fee schedule of 45 basis points for a similar size investment. We came to terms for a blended rate of 37.5 basis points for a $400 million allocation. This translates into approximately $300,000 a year in savings. But I would note that due to MFNs, it's on the term sheet. If AUM were to fall below $175 million as a result of redemption, our fee would revert to a higher fee schedule. In closing, we believe this investment to be a complement and improvement to the mixed credit portfolio. We're recommending up to a 4% allocation in a separately managed account held in bank custody at the Bank of New York Mellon with an estimated initial funding of $400 million. We're confident in PineBridge's expertise in below investment grade credit, their focus on fundamental credit analysis, their commitment to their process, but also process improvement, and believe that their ability to generate strong risk-adjusted and excess returns will benefit our portfolio if this recommendation is approved. I'll pause now and take any questions that you may have.
No questions? Have a motion?
Okay. Mr. Chairman, the motion would be adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated February 26, 2015 regarding PineBridge Investments, LLC. 2, authorize an investment of up to 4% of planned assets into the PineBridge senior secured loan strategy through the use of a separately managed account. 3, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014, or as the review period may be omitted or superseded by the commission, and 4, authorize the chairman and or the CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust fund's obligations with respect to the investment.
Motion to approve.
So moved.
Second.
Second.
Motion's been made and seconded. All in favor? Aye.
Aye.
Motion is carried.
Unanimous?
Yes.
Okay.
Unanimous.
great.
All right.
Mr. Chairman,
Yes.
next is the Morgan Stanley Prime Property Fund. Mr. Ravelli will present this as well. Is there something?
Before we proceed, I'd like to make the following statement. In accordance with South Carolina Code Section 8-13-700, parentheses B, I will not be participating in the deliberations, voting, or other actions on the matter before the South Carolina Retirement System Investment Commission regarding the Morgan Stanley Prime Property Fund. I retired from and receive a pension from Morgan Stanley. Thus, to avoid a potential conflict or even the appearance of impropriety, I will recuse myself from the vote. I understand that this statement will be attached to the minutes for the February 26, 2015 Commission meeting. So, you may proceed. So I understand I do not have to leave.
No, you just don't participate. But you have the chair.
Oh. Mr. Ravelli, please.
Today I'm going to present an investment into the Prime Property Fund. That's an open-ended index sponsored by Morgan Stanley. First, the staff is recommending an investment up to $400 million to the fund. The target is $100 to $200 million of that to be invested over the next 1 or 2 years, and then the balance to be invested as we see the opportunities arise or pacing allows. So today I'm going to first talk about how Prime fits into our 5-year plan. This is the plan we talked about last year. Talk a little bit about Morgan Stanley as an organization, how the assets of Prime fit into the total assets, total real estate assets of Morgan Stanley, and then also talk about the fund's profile, its performance, and finally the advantages and considerations. So the top half of this slide, you've seen this chart from last year. This is our 5-year plan in graphical form. Basically, we are heavy non-core, which Suzanne, I think, talked about this morning. We're moving it over the next 5 to 7 years to a more balanced portfolio. What that basically means is that we're trying to build a core portfolio over the next 5 to 7 years. The bottom table kind of shows the yellow highlighted is where Prime would fit into that. That's basically an annual allocation of the 5-year plan. And so you can see in the top row was where it would fit into the 5-year plan. So we're really doing this in 3 phases. Phase 1 was the fund of one accounts, which we got approved in November of last year. TA for $300 million and Greystar for $150 million. And the second phase is today with Prime is a core open-ended fund, again, up to $400 million investment. And then finally in April, I'll be bringing basically a core plus open-ended fund. And that should kind of complete the process. And at that point, we just kind of go forward with the investments and build it over the next 5 to 7 years. So when I started this search, I really had 5 objectives that I was looking at. First, we were looking at the core open-ended fund to be the real estate beta portfolio, so kind of the anchor to the real estate program. So that was definitely the intent. I also wanted to see that there was kind of a complement to our fund of one accounts. I didn't want them to be the same. I wanted them to be different, add us to very different things. One of the things that I wanted to see was exposure to large central business district CBD office and regional malls. I wanted it to be concentrated in the best markets, which these funds, they're being so large, they allow you to do that. And then also I wanted to have a fund that has outperformed historically the Odyssey Index, which is basically our benchmark, and that's an index of about 23 open-ended core funds. So Morgan Stanley, as most of us know, is a global firm. They have 55,000 professionals globally, 200 in their real estate group. And then Prime is a U.S.-only open-ended fund, and it shares the resources of the U.S. team, which is about 65 members. So Prime itself as an organization, one, it's part of the merchant banking and real estate group, so it's underneath that. It's led by 4 portfolio managers. Scott Brown is the lead. He's been in real estate for 24 plus years, Morgan Stanley 21, and he's been working on Prime for 11. He headed it up back in 2007, so he's the lead PM back in 2007. On the bottom here, you can see basically the 65-member team that we talked about, which is shared resources between the other U.S. mandates. And then up here, basically, are the 2 entities that oversee the fund. The investment committee, a 12-member committee, and then the board of directors. I'm going to talk a little bit more about the board of directors. So the board of directors is a 4-member team, 3 of them independent directors, and then one, John Klopp, is the affiliated director. The primary thing of the board is to oversee the fund performance, replace and remove the advisor if necessary. They approve investment guidelines, they'll oversee the valuations and the audits of the fund, and then they'll resolve any conflicts. So in terms of assets under management, you can see that about $33 billion of real estate assets total for Morgan Stanley, and the fund here highlighted in yellow is nearly $15 billion. So it represents about 43% of their global assets for real estate, and then 85% of their U.S. assets. So it's a very significant part of their investment strategy in the real estate. This slide here shows the fund's profile. Basically, as I said, it's a $15 billion gross fund, gross asset value fund. It's 317 assets, so it's well diversified. 226 investors, so it's, again, well diversified by investor. It's about currently at 22% leverage, loan to value. We'll talk a little bit more about this in another slide. And they target, on a long-term basis, about 25 to 35% loan to value. The only number I really wanted you to kind of look at here is right here, this 9%. So this is the time-weighted return gross of fees back to 1973 when this fund started, and it's been nearly 9%, so they've done very well. So the next 3 slides, I'm going to be talking about the diversification of the fund, which was something that I spent a lot of time on trying to understand. And you can see the top chart, one looks at the diversification by U.S. region, and you can see that it's very diversified across the 4 regions. On the bottom, this chart here talks about their diversification by property type. And primarily, what you'll see there, if you were to see the numbers there, and I know a little hard to read maybe, is 92% of the NAV is in the 4 main property types, which is what one of the things we were looking for. We wanted to keep it simple. They do invest about 5% in self-storage, which they've done very well on. So that's primarily how they're diversified. The tables, the charts to the right, basically look at the prime fund relative to Odyssey currently, as of third quarter of 14. But if you look back to like 2009, pretty much the fund has been plus or minus 4% of the index. So it stayed pretty well in line with the index. But where they've really outperformed is that within those groups, the subsectors, is where they've added overweights and underweights. So for example, if you look back 7 years, regional malls, they were overweight by almost 10%. And they were underweight by 12.5% for the other retail. And you'll see on another chart that we get to that regional malls have outperformed those groups very well, so that's been a real plus for them. The other thing that they've done is they've had an overweight in CBD office of about 8%, and in suburban office, minus 8%. So what they're doing is they're overweighting and underweighting within those main groups here, and that's how they're generating a lot of their alpha. This slide here really just shows the diversification by MSA, the Metropolitan Statistical Area, which basically is just an expanded version of the main 6 markets or all these markets. The dark blue shading is really the top 6 markets, which is what we were looking at to see their concentration. And as you can see, there are about 57% of the gross asset value of the fund is in those blue markets, in those top markets. The next 10 markets represents 36% of the fund. So looking at this fund relative to the other Odyssey funds that we looked at, this definitely had a higher proportion of the top markets, which is what we were wanting. This is an analysis, almost there. This looks at really the diversification, because we know there's 317 assets in the fund, but to look at the top assets and how much of the fund gross asset value they represent. And so you can see on this table that to the left, the blue bars, that represents the individual locations where these top 25 assets are located. And you can see that they pretty heavy in the top markets, again, as we expect. Off to the right, it's basically looking at the cumulative of how much the gross asset value is in these 25 assets. And so we see that 53% of the fund is in these top 25 assets. 100 assets represents 85%. So they're well diversified, but they're concentrated in very large assets in the best markets. This is just the investor profile. So again, they have 226 investors. 32 of those investors have invested over $100 million into the fund. And you can see they're well diversified by investor type. The bottom table looks at the net cash inflows or outflows since 2004. And as you can see by the gold, that they have done a lot more net inflows into the fund than they have outflows. And the only year where they had a negative outflow was in 2008, as expected, during a recession, and about $350 million. So it's been a positive for the fund as it's grown. This slide really just shows how occupied these assets are. And as you can see, across the property types and across time, these are well occupied assets in the fund. Pretty much what you see is low 90s to mid 90% occupancy, so as we would expect in a good core fund. And finally, this basically again shows that 91% of the assets in the fund are in mature operating assets, stabilized assets, again what we'd expect. But the fund can invest up to 15% in non-core strategies, development being one of those. So that allows them to pick up some extra return as they go. This slide here shows, the next two slides show performance. This slide here relative to the Odyssey Index, which again I talked about was the 23 funds, open-ended core funds. The top chart is the gross of fees and then net of fees. I'm just going to primarily just look at these two numbers here on both charts, 5-year and 10-year. And you can see on a gross basis, they've outperformed by 150 to 220 basis points over a 5 and 10-year period. And then net of fees, 140 to 190. Now these are leveraged returns for these two charts. This chart looks at on an unlevered basis, so we're trying to see what the assets are doing, absent any kind of leverage effect. We had to use a different index because Odyssey doesn't have a unleveraged index, so this is against the IPD. As you can see here under 5 and 10 year that it's outperformed, even on an unlevered basis, 150 basis points over that 5 or 10 year period. And that's predominantly, we talked a little bit about the overweights that they've made. That outperformance, if you go back 7 years, has been basically they're overweight to regional malls. They've done very well with that. But they've also done very well with their selection of malls. Their malls are getting higher returns than the index. They've had a pretty significant underweight to suburban office. That's done well to them because, again, CBD office outperforms suburban. Their underweight has really helped them. And also, they've done very well in the asset selection of the apartments, not necessarily just the apartment space. The allocation effect's been pretty small, but they have done very well on the asset selection. And then they had an overweight, again, 5% of the fund. I think the index was around 2%. They've done very well there in terms of their contribution to that alpha you see there. And this is the chart I originally was going to. This is Hewitt's analysis. What they looked at here was basically 18 funds. I believe these are the 18 funds that had 5-year returns. They looked at the 18 funds over 20 quarters of returns. On the left, basically what they're looking at is what percentage of the time during those 20 quarters that those funds outperformed the index, the Odyssey Index. And as you can see, here in blue is the other 17, and then prime in orange is right here, and it's the top. It's up near 80%, so it beat everybody else over that 5-year period. And then the red dots are the right-hand scale, which basically show the excess return over the index over that 5-year period. And they're second highest at 200 basis points, so they've done very well and consistently well. Now, this slide is the one I talked about before, where it kind of shows you how, regional malls have done relative to, the other types of, community and neighborhood centers, and then how CBD, and this is over a 10-year unleveraged basis, how CBD office has done better than suburban office. So their overweights have worked for them, and that was something that we were looking for because we wanted that exposure. It was not something we're going to get in anything else what we're doing. And just in terms of size, for example, if you look at the average gross asset value of their, and this is not for this chart, but of Prime's portfolio, their average office is $234 million. So these are very large assets. And then in their retail portfolio, 78% of that retail portfolio is in basically malls. And then they have some high-end, other types of retail with it. But it's predominantly a mall portfolio, which again was of interest to me. So the advantages of the fund, we've talked about all of these, but to kind of summarize, the fund is diversified by both region and property type. It invests primarily in the four main property types. It has a significant exposure to both CBD office and regional mall. It's exposed, basically it has a large exposure to the top 6 markets. These are high quality assets, and as we saw by performance, they've outperformed the index significantly. This is the one consideration that I saw for the fund is their leverage, and I'm not really sure that this is a gigantic issue, but ultimately what you see here is this is the universe back through 2005 of the Odyssey, and the blue dashes are basically kind of the average Odyssey leverage ratio per year, and then the yellow dots are Prime. And as you can see, Prime really has been higher in all those periods until just recently it's moved it back down into just below where the Odyssey is. But if you look at there, and it's not there, but I can say if you kind of took that average loan to value, it was basically 32% for the fund and 24% for Odyssey. So it's not much of a difference really that they've been over it. And currently it's at 21%, and the Odyssey index is at 22. So it's actually gotten itself down lower. The target is 25 to 35% loan to value, so they're actually lower than that right now. And talking to them, I think they're planning on keeping it relatively low. The important factor is, though, during this period, this is kind of when Morgan Stanley took over the fund, is they've never given an asset back to the lender, and they've never breached any kind of covenant with any lender. So even though, and my understanding is they have like a 3 times coverage. So they're, even though it's a little higher leverage, it's not that significant as far as I could see. And finally, again, a recommendation to the commission is to invest up to $400 million into the fund, targeting $100 to $200 million in the next 1 to 2 years, and then the remaining as opportunities and pacing allows. Now I'm open to any questions.
Well, in 2008, were any barriers to withdrawals other than the quarterly?
There was that $350 million the cash outflow in 2008. It was they had a small, I think I don't remember which chart it was.
Well, I mean, yeah, were there any barriers to people getting their money? I mean, they sent out 350, but the people want 700.
Yeah,
maybe gates or lockups.
Absolutely. Typically, what happens with these funds, and I don't have those numbers of how much was in their queues, but what'll happen is that all these funds, when the recession hit, they go into an exit queue, and so you'll sit on the exit queue until they have available cash. They're not going to force a sale of the assets to do that. And so you could be sitting on that, and that's actually, I think, what happened. A lot of them were on the queue, but then the market started getting better, and they said, well, okay, take me off the queue. And that's what ultimately happened. So in the end, they only really paid out about $350 net cash flow. But I imagine the queue was a lot larger than that.
Yeah, yeah, it was.
So, I mean, give us a sense of what current pricing looks like. I mean, are you in at book value? I mean, how do these funds sort of mechanically behave? Are you in at book? You in at a premium to book? What's sort of the current, yield look like? I mean, I know we looked at the historical stuff there, but I mean, what's it look like currently and prospectively?
Well, I think it's hard to pinpoint it exactly, but I would say they target 7 to 9. That's what they say. I think we're.
But that's at purchase. That's at their.
No, that's
off of
that's a
purchase.
return expectation, 7 to 9 unlevered, or
Right,
actually
but
levered.
when they're
excuse me.
purchasing a property, not when we're purchasing the fund,
Mhm.
right?
So they're obviously marketing it to market. and
Right.
An external party's doing that for them predominantly.
Right. Quarterly.
The expected returns, as he's pointing out right now, for core real estate in a well-diversified portfolio like this, is probably over the next 3 to 5 years in the 7 to 9% range. That is a reasonable, they've earned much better than that. in the last
Yeah,
couple
and
of
that's what I was
years.
going to say. It's coming down. So this year, they may get higher than that, but I wouldn't expect that. We didn't really go into that thinking that they would. If you would have gotten into this fund, let's say 3 years ago, you would have benefited from maybe 3 years of above, 10%.
10%, right.
But-
Most of it's going to be coming from income too. So, you've got a nice income stream that's coming off of it. The appreciation is somewhat muted.
Mhm.
This is a fund that has a little bit of core plus, so it does have a little bit of latitude for some additional runway. But it's, we view these core funds as really more of a beta play for the broad real estate market. So you've got your, alpha producers through the rest of the portfolio. This is expected to earn a little bit of alpha, but that's not the predominant reason you're getting it. It's for the broad-based diversification, that stabilization from the income.
Right.
So it's something that we think is a very nice combination, but is not going to be necessarily your best performer in the real estate program over time.
So I guess the one thing is,
Yeah,
these
I
assets.
get all that. I mean, but my question was, what are we paying relative to the book value of the assets?
Well, we're buying it in NAV.
Yeah,
Right.
you buy it
And NAV was,
always,
it's
and
being
you sell
appraised
it NAV.
quarterly.
You
Right.
exit it
So
NAV.
I
But
suspect
then
it's wherever
NAV
appraisers
and the
are.
book value aren't one and the same, right? A fund can be at a premium or a discount, presumably, right?
Well,
Yeah, to cost.
Yeah, and it may be, I guess the way I look at that is that maybe the appraisers haven't caught up to where the market is, and there may be some room still that those values could be marked up even further, and then we'll gain a little bit from that at being exposed to it. But it's really, I think by this time, I would suspect most of the appraisers have worked through all that. There's a lot of transactions going on. They have a lot of things they can use. So I guess my point is I think that NAV would be probably pretty close to,
Right.
to the book value. So we might get a little bit, but I'm not really relying on that. I'm really relying on Morgan Stanley being able to add the alpha over time, because that's really what we're trying to do.
This isn't intended to be an opportunistic
No,
component
but I
of
mean,
the
if you're
program.
saying 7 or 8, I mean, I'm just thinking of
Yeah.
high-quality REITs, right, that are
Mhm.
publicly traded, right? I mean, that's 300 basis points above the REIT market, which I get. I mean, there are differences, right, going direct versus REITs, but 300 seems awfully, I mean, I don't know, if, for a core type versus a high,
Right.
So maybe that's a realistic expectation. I
And
mean,
maybe
I
that's
don't know.
something to
I'm not a real
add
estate guy, I'm just
as
asking
well.
the question.
Yeah, so might REITs earn a higher return than core real estate over time? Yes. There are other qualities to the core real estate that we think are very attractive. So the stability of returns, obviously the income, it's a fantastic diversifier to the rest of your program at a return expectation that's quite a bit higher than really any other stabilizing asset you have in the program, with maybe a couple exceptions, the credit space, but definitely higher than bonds, definitely higher than anything that's in the conservative space. So there may very well be, I know you all are looking at REITs as well, so that may be something to add also. But I would see them as serving two different roles within the real estate component.
Yeah,
This
and
is
I'm
much
not
more broadly
absolutely
diversified.
sure that they're the same exact type of assets either. That REITs may do, not exactly the same. These are pretty high-quality assets. I think REITs probably do, but, and then you get the public pricing in there, so it's a little hard to do it. But no, I think that definitely within the range of, even if you look way back historically, this is kind of the return they got, like a 7. Morgan Stanley would be like a 7.5 net of fees. The actual index, I think, is in the probably net of fees in the 6.5 range.
Yeah.
6.5 to 7. And so that's kind of our expectation. I do think we might be able to pick up a little, but it's a little late in that game, I think, in terms of us. That's one of the reasons that we're holding out the capital of the $400 million, is have it available for when the market does reset. That opportunity comes fairly quickly, and you got to jump at it. In essence, you can get these funds at lower NAVs, and that's when you're going to get that upside. But right now, we're kind of at the tail end of that. But we still need the exposure.
Right. And they pay what, monthly, quarterly? I mean, how mechanically they flow through that income? Is it a monthly pay, a quarterly pay?
Well, I think it's quarterly distributions probably, and then we'll most likely have that reinvested. So the fund will continue on and just get larger for us.
Any further discussion? I believe we have a motion. Would you like to read that?
Madam Chairwoman, the motion would be adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated February 26, 2015, regarding Morgan Stanley Prime Property Fund LLC. Authorize a capacity of up to $400 million to the Morgan Stanley Prime Property Fund with an initial subscription of up to $200 million. Authorize the CIO to allocate the remaining capacity into the Morgan Stanley Property Fund with the timing and the amounts to be allocated within the discretion of the CIO, so long as the total subscribed does not exceed the initial $400 million application. Authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014. 5, authorize the chairman and/or the CIO or their designees to thereafter authorize a custodian of funds to transfer such funds as are necessary to meet the retirement system's trust funds obligations with respect to the investment.
Is there a motion as such?
So moved.
Second? All in favor? Aye.
Aye.
All-
Yes.
Okay, it's approved unanimously.
Mr. Chairman, that's it.
Is there any other business to come before the commission? If not,
Motion to adjourn.
let's have a motion to adjourn.
Second.
Second,
So
all
long,
in favor?
everybody. Bye-bye.
Aye.
Feel better.
We stand adjourned.